House prices rising by 0.7% in a month, nearing a record high then for UK house prices. And despite affordability challenges, they are expected to climb further in 2025, according to the analysis they cite. We have a focus on mining stocks as well. Chinese data coming in a disappointing fashion. Mixed picture, though, on mining, on the metals, though. Copper down, iron ore up. Deutsche Bank also in focus after some comments to the FT then, Guy.
So, Anna, at least the Chinese markets have delivered some action today. European markets are not expecting a great deal from. Here we go. It's time for the opening trade. A lot of caveats are going to be applied here. Remember, as we've already indicated, the Swiss market is going to be closed today. It'll be interesting to see exactly how the main markets do open and what they ultimately deliver. The FTSE 100 is looking a little light this morning. I think we're probably sort of missing some numbers here, but nevertheless, I think we are looking a little soft. But I really struggle to get a decent takeaway from what is happening here. Don't see much yet on the CAC, which is just dipping a little bit. The Italian market's open. The DAX is up just a touch. But is there a clear indication here as to what market sentiment is really looking like at the moment? I think market sentiment is still probably tucked up at home with its slippers on, watching the television and still trying to figure out what 2025 is going to deliver. That's probably where we are. Monday, probably a better day.
I feel like I should have worn my slippers to set today. That certainly is the vibe around here. But when it comes to these markets, it does feel like there are some fundamental actions, fundamental kind of trades at play, because the outperformance in the Stock 600 and I should say the FTSE 100 right off the bat, Anna, is in the commodity sector. I'm seeing it not only in the basic resources space, so Rio Tinto, for example, Glencore catching a bid, but some of the kind of natural gas exposed names as well. Shell, for example, BP, the ones that are perhaps moving off the commodity trade. Those are your biggest upside movers in the Stock 600 this morning.
Yeah, so certainly there is some read across, if you're looking for it, from the Chinese story, although not necessarily in the same direction as Chinese stocks moved, because that's where we saw quite a bit of weakness, continuing weakness on that Caixin data that sort of reinforced the negativities that we'd had out of the official PMI data. So there was that weakness in China, and then somehow we turned that into a positive here in Europe. But basic resources up by 1%, energy stocks up by 0.8%. To your point then, Chrissy, utilities, retail also stronger. There are, broadly speaking, around 3/4 of sectors are moving higher. Yep. So something has given us enough energy to get off the couch, get off the sofa, and trade a little higher this morning.
We're not all working from home. I just want to go into Vestas and just see what's happening there, because that stock is actually performing quite strongly. And I saw a note out a little earlier on. Sid Bank talking about this. Vestas year-end Q4 order rally, quote, solid, significantly better than the previous 3 quarters, according to the bank. This is in a note after the wind turbine maker announced orders in the US as well as Italy, France, Spain over the last few days. So that seems to be being priced in to Vestas. Vestas is up by 4.5%, the biggest points gainer on the Stock 600 this morning.
It's certainly something we're going to be keeping a close eye on. Let's get a little bit more market analysis here, because I think when we keep looking for threads today, we may not always find them. But hopefully Dan Kemp here will rescue us, Chief Research and Investment Officer over at Morningstar, joining us around the table this morning. Dan, Happy New Year. Thank you so much for joining us on this January 2nd. We are looking for threads about what's going to be driving these markets in 2025. Guys obsessed with January 20th. Is that really the date when things kick in?
It's going to be a really important one. Hello and Happy New Year. Yes, as you've already said, we should be very careful about drawing any inferences from trade today and tomorrow. We know, as you said, that most people at home, they've got the slippers on, they're not trading, they're not thinking about markets. And as a result, we can see high levels of volatility coming in these sort of markets, low liquidity, and so it's important we don't draw too many inferences. January 20th is going to be absolutely key. That's when the reality of the new US administration kicks in. But we've been dealing with that reality now for a few months, and we've seen some of the trades and the trends that are likely to come through that administration. And what we're seeing is some of those trends now begin to peter out. The back end of last year, where a lot of optimism's already been baked into prices, we're seeing some overvaluation in the US, we're seeing some undervaluation elsewhere in the world. So we're well set up for a really interesting 2025.
Well, what do you do in that environment? I mean, we keep saying that maybe we'll know about the Donald Trump policy, the Trump effect on day one or day 100 or whatever, but the kind of consensus is that we may not even know day to day how consistent his policies are or what that means for the reaction function in Europe or in Asia. How do you hedge in an environment like that?
That's a really important point. Yes, you're absolutely right that we have to remember that politicians don't always get what they want. And that certainly seems to be the case in the next US administration. And also politicians don't always do what they say they're going to do. We know that across the world. And so we shouldn't make that the basis for our investment decisions in 2025. Much more important to follow the fundamental growth and also, even more important than that, the valuations. And what we've seen happen over 2024 is these big gaps in valuations build up because of the momentum in the market. And so if you're looking to hedge your portfolio in 2025, then head for the lower priced parts of the market, smaller companies in the US, traditional industries, the emerging markets, parts of Europe, all these areas that have got left behind where there's a cloud of negativity. Now, not all of that negativity is sort of emerged from nothing. There's plenty of reasons for people to be negative. That's where the value is. That's where the opportunities are.
Dan, the problem with that is that you could have said the same thing at the beginning of 2024, after a year in which the S&P had outperformed and the market had got more narrow. There were plenty of areas at the beginning of 2024 that had been left behind. But if you were a euro investor, the S&P still kicked out 30% last year. Why does that trade not continue? Why is now the right moment to switch into those underperforming areas? You could have said the same thing throughout the entirety of last year.
Yeah, that's absolutely right. That for last year we did see that increase in valuations, but we've got to remember that at the beginning of last year the valuation gaps weren't as extreme as they are now, and so for most investors who are taking that longer-term perspective, they're going to be gradually moving out of those most expensive stocks as they become more expensive and into the less expensive stocks, because we can expect some form of rotation as those valuations become increasingly disconnected from reality. What surprised everyone last year was the fundamental strength of those large technology stocks in the US, NVIDIA being the classic, but others showed some real growth as well. And so that certainly supported the market. But when you're seeing big gaps, then it makes sense to gradually move away from the most expensive stocks and into the less expensive ones.
Why? Why would I do that? In a situation where the AI trade looks like it's still intact, other areas of the global economy aren't looking so good. Why would I want to do that? Why do I want to go into areas where we're seeing economic weakness? This is a kind of reverting story that I'm hearing from a lot of people. We are going to see these gaps closing. Why are these gaps going to close?
Well, because what we know about investing, as you know, as well as anyone else, is that over the long term, there is a trend towards the fair value of businesses. And so if you're buying businesses that you believe to be overvalued at the moment, then that has a low expected return over the longer term. Now, we know that market momentum can continue to push these stocks forward for a while, but we also know that when you look back on these situations, typically investors wished that they'd moved from the most expensive stocks to the less expensive stocks after some sort of market event has occurred. The challenge is we never know when that's going to occur ahead of time, which is why you need to gradually be moving before that happens into those less expensive stocks.
Okay. And Dan, just to test that a little further then, because you say that Europe is the most attractive developed market for you, and that's on valuation grounds, and you point to one sector that's done really badly and say how cheap it is, European car makers. But do you see a catalyst that changes the narrative around European car makers, that isn't dominated by the difficulties they're having selling cars at a price that people are prepared to pay up against competition from the likes of Tesla and the Chinese manufacturers?
Yes, and that is a big structural challenge. It's important to take that into account and not to disregard all the challenges that those European car manufacturers are facing. But we believe that it's already all in the price, that these car manufacturers are deep discounts to their fair values. And so even with all of that pressure taken into account, we still see some good investment opportunities ahead. And that's why it's so important that people separate the fundamental prospects for these businesses and those challenges and with the valuation. And so everyone's finding it very easy at the moment to highlight the bear case for these stocks, but we believe that's already priced in. And also in other parts of the world as well. If I mentioned US smaller companies, another area where people are struggling to see the upside, but we see plenty of value.
Okay, yes, and talking about where you see the upside then, you also like some emerging markets, I think, Dan. Tell us about where you see opportunities there going into 2025, because last year was dominated, of course, by China and disappointment around the Chinese growth story, well, apart from September, where we saw some enthusiasm.
That's absolutely right. And I think September was a really interesting case study in what happens when sentiment changes quickly. And although the gains that we saw then have faded a little bit, what we witnessed then was a very rapid turnaround where people started re-examining China because of some unexpected economic announcements that went a bit further and changed people's minds. So that's the sort of thing that we can see when sentiment changes. It's just very difficult to see that ahead of time. You typically only see it with the benefit of hindsight. So we still see China as a very attractive market. Specifically, it's the large technology-driven stocks in that country which look so attractive to us. Almost the polar opposite of what we're seeing in the US, where these stocks are so highly valued, they're so loved by everyone. But in China, they're not. They're great businesses trading at very attractive valuation. So we're seeing the opportunities in China. We're also seeing some opportunities in Latin America as well. The only place in the emerging markets we're not seeing great opportunities at the moment is in India, which of course has been the benefit of an enormous amount of positive economic news and also good market sentiment as well. So as with everywhere else in the world at the moment, it's not just one picture. You need to dig a little bit deeper than the headlines and really get into the individual stocks and sectors to find the best opportunities.
Well, Dan, speaking of kind of getting into the nitty-gritty there, talk us through kind of which asset class may be the dog wagging its tail or tail wagging its dog for the equity market. And I say this in the context of so much focus being put on the currency picture, that the weakness in the euro may incentivize a bid into European stocks, or dollar strength may disincentivize flows. It's a similar narrative that we heard in commodities, say, 2 short years ago. What is the asset class that may affect stocks from the outside?
Well, again, a really good question. And I think it's really important for equity investors to be looking at the bond market this year. And as we look at bonds, obviously we saw yields go higher at the back end of last year. People have been really discouraged by bonds, but on the other side of things, corporate debt are trading at very, very skinny spreads. And that shows you the degree of optimism that we're seeing in the corporate markets and the degree of pessimism about the economy that we're seeing in fixed income markets. We know the fixed income markets are the biggest markets in the world, and so very important that equity investors are thinking about what's happening in bond markets and what the read across is from those bond markets into equity price and optimism. And what we see there is that overarching optimism at the corporate level, but a fair degree of pessimism still at the economic level, and that's impacting government bond markets.
And certainly we'll see if that kind of yield level, the 5% line in the sand, has that maybe scare factor in the equity market. Dan Kemp, we thank you so much, Chief Research and Investment Officer over at Morningstar, joining the program this morning. Let's get a quick check on some of the individual stocks on the move. Joe Easton standing by. Joe.
So Vestas is the best performing stock in Europe by some way. As Guy was mentioning earlier, this is due to the orders that the company announced during the market closure in Denmark over the New Year period. Now, analysts at Sidbank and also Citi writing that the company is offsetting concerns around a reduction in spending in the US. There were some big projects that were cancelled in terms of offshore wind, and these orders do seem to be countering that at the moment. That stock rising 6%, leading the gains in European shares this morning. Then in terms of home builders, we did get those numbers earlier a few moments ago from Nationwide saying there was a jump not only in the monthly price, also in the yearly, around 4.7%, the biggest gain in a couple of years, and seeing a bit of support in those UK home builder stocks there at the moment, likes of Barratt and Persimmon among the shares gaining at the moment, though volumes do look pretty thin on that market today. The miners also getting a boost, a bit of a mixed market to read this morning given the declines in Chinese shares, but then again in terms of the copper prices, iron ore futures kind of bouncing around in the morning, but decent moves higher in those London listed miners in particular. Glencore, Anglo among the gainers as the London market reopens, looking pretty good on that market today. Then in terms of gas prices, I made the mistake of checking the BBC weather report earlier. It's going to be -1 in London tomorrow. That is supportive for gas prices, but also the main thing is around this contract between Russia and Ukraine that has now ended, and that is supporting gas prices and benefiting companies like Centrica, the British gas owner, rising a little bit, but some bigger gains in the likes of Neste, Equinor, all of those stocks rising given the jump in gas prices that we are seeing this morning. Then we were going to check in on AP Moller Maersk because the company is warning that potentially there could be a US-wide strike coming into force in mid-January if they do not resolve some of their issues around labour disputes. But I think it's more about the energy market supporting that stock today. We're gaining 1.3%, but one to watch as those union talks continue. AP Moller Maersk rising 1.3% in Copenhagen this morning.
Joe, thank you. Joe Easton from our equities team, ending on the global trade story that is Moller Maersk. Thinking about global trade, China this morning making it a little bit more difficult to export to some US businesses, and the relationship between the United States and China very much in focus this morning. We have China adding 28 US firms to its export control list, adding some US companies to its unreliable entity list. And I suppose it's not a surprise to anybody that the relationship focuses on dual-use technology. That's been the case on the States, on the US side as well. But for example, Boeing Defense, Space and Security on China's export control list, Lockheed Martin on the export control list as well.
Again, we wait for the 20th. We wait to see what the reaction is going to be around the world. We wait to see, is this the...
Interesting New Year salvo, though, from China.
Yeah, China's going a little early on some of this stuff, but the outgoing Biden administration has also been ratcheting up the pressure. Is that a reaction? Is this a reaction to that?
Yeah.
We haven't even got into the Trump stuff yet, which is going to come later on in this month.
Well, I think what's scary about this Lockheed Martin angle in particular, because, and correct me if I'm wrong, Boeing used to have a lot of China exposure, and I think it went something like from 12% to 3% in the span of a year a couple years back. Lockheed Martin and Boeing were the only two aerospace and defense companies that people had exposure to in the U.S. credit market, so AAA investment grade kind of credit market. So if you suddenly don't have access to Boeing because of the headlines around Boeing and the concerns around the company there, Lockheed Martin was kind of your only remaining government solid exposure from a corporate perspective. And now if we start to see this kind of accelerate around the world, you have some allocation to figure out in the credit space.
But you've got Europe. Europe needs to spend a ton of money on defence. Like Lockheed looks like a pretty solid bet on the back of that, makes a lot of the kit that Europe is going to need. Europe wants to go domestic, but it's going to have to partner with a lot of these big US companies to make that happen. Is that where the trade lies with some of these big defense companies? You may see US defense spending being fairly static, but Europe has got a long way to go in terms of the numbers that it needs to post.
Yes, maybe the writing was on the wall in terms of this US-China relationship. We'll continue to watch how it develops then through January. Let us tell you what is coming up on the programme, with AI and China set to be key themes in 2025. We will home in on 50 companies to watch as identified by Bloomberg Intelligence. That conversation next. This is Bloomberg.
trends at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me, but we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Romaine Bostick in Detroit, and this is Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
In case you missed it, on Bloomberg Open Interest.
We'd love to hear from you. We'd love to hear what you think about our shows here on Bloomberg Television. Do you think we're doing well? Do you think we need to change some things?
Do you like Matt Miller?
Should I wear a wig on a regular basis?
Please write that in. I'm scared.
The first monthly loss for the S&P in 7 months, 30 minutes until it started trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Don't miss Open Interest live weekdays.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Themes that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Thursday, the 2nd of January, good morning. Welcome. You are watching the opening trade. There has been an opening trade. Trades are happening. Not many of them, but they are definitely happening. Equity markets are a little bit higher. It's interesting, the Vestas is having a very strong day today on the back of a series of orders that have been placed over the last few days. That's being priced into the market. But as you can see, it is a fairly cautious start to 2020. What are we, 2025?
Yes, correct.
So I'm just double checking. I nearly said 24. 25. I think we wait for Monday. I still, and Critty's going to roll her eyes at this point, still think we wait for the 20th before we actually start to get really an idea of what's going on.
Yeah, I don't know. I just feel like we keep talking about this like volatility being this very normal, new normal, old normal, but new normal. And I don't know.
It's the Trump 2.0, and I'm not allowed to say that playbook, isn't it?
Yeah.
Volatility is that's the trade for 2025.
But then also he can change his mind. Right?
Precisely, isn't that volatility?
Yeah, yeah. So yeah, but we'll know more on January 20th, perhaps, but we won't know it all.
Everything.
So maybe, and what we know might change. So there we are. Things are clear. 8:21 here in London on the 2nd of January. That's how things look. Global stocks registered a second consecutive year of gains, though, in 2024. Bloomberg Intelligence has compiled a list of 50 companies to watch this year, with AI and exposure to China among some of the really common themes that we're looking at here. Tim Craighead, Director of Equity Research at Bloomberg Intelligence, joins us with details of more. And so AI, Happy New Year, Tim. Should start with that, shouldn't we, first? AI was such a big focus for investors last year. It seems from the outside as if it's largely a US phenomenon, maybe not entirely a US phenomenon. Talk us through that AI theme.
Yeah, absolutely. It was a big deal for us last year. This is an annual project we do. It largely boils from our focus idea list of stocks, a broader list of stocks where we have high conviction and we see catalysts ahead to change the market's mindset. AI was a big deal last year. It was software-oriented, LLM-oriented. This year, it's more enabling technology. So think semiconductors like Broadcom, which help make networks work, or Micron Technology, which is high bandwidth memory. It's more things like that. So it's sort of spread out. And from a European perspective, a name you might not have heard of before, VAT Group. They make valves, and you think, what? No, valves are quite important to create vacuums, and you have to have a vacuum to make semiconductors. And so their high-end valves are a big deal. So it's looking for enablers like that, and there are ideas like that beyond the U.S.
I remember this, 2000, people were talking about buying picks and shovels for the internet era. Valves, that's where we are right now. The area that we're focusing on this morning is actually China. And you do wonder what kind of a year China is going to have. A lot of people have backed away from their exposure in China in 2024. Is the picture different in 2025? And which companies are you looking at when it comes to China as being the kind of the clearest, cleanest read on what is going on?
That's interesting. Again, it was a big deal for us on this list last year. We were negative, a lot of oriented towards the property crisis. And you could say, gee, aren't you that way again this year because of, say, tariffs? We actually take a constructive view. All the China ideas that we have are positive, which might surprise you. Think HSBC. It's about wealth management and wealth flows, which actually are quite significant and being pushed outside of property. HSBC has a new CEO. We think that there is a wealth drive. There's a cost-cutting angle as well. It's an interesting idea. CITIC Securities is another one in China that way. We think some of the metal companies, and these are globally oriented, but think Vale, the big iron ore company, and there's also an aluminum company in China. Think Rémy Cointreau, which has a big Asia-China business. If consumption starts to pick back up, quite a depressed stock, along with a lot of the other luxury and beverage type companies.
Well, speaking of that luxury and beverage type company, can you just walk us through the China impact, though, from a investor standpoint? I mean, you're talking a lot about the fundamentals, but there's been so much of shying away from China, only to come back when the valuations are so depressed, it doesn't make sense to not own it. Is that still the same dynamic into 2025?
Yeah, I mean, I think it is. And this certainly was a knee-jerk positive when the initial stimulus announcements came, last autumn, and it sort of faded away, and still sort of waiting for Godot with some of the big details of stimulus still to come. And I think we are in that sort of in-between period. The thing to do is pick the companies that are fundamentally well-positioned. Valuations are quite depressed, and we are looking for ideas like I had just mentioned that might be an asset flow perspective or an underlying consumption perspective.
Just briefly, Tim, there are a few things there that you say there's risk to consensus. What's the driver there? Yeah,
about 20% of our 50 companies are on the negative side, and they're all good companies, but we see expectations that are just simply too high. Nintendo, there's a product delay on the new Switch. Palantir, that might surprise you. That's one of those big AI names. Look at the stock. It's been a rocket ship, but we think expectations are just simply way too high relative to what we anticipate that company coming through. There's several others like that.
Okay, Tim, thanks so much. Thanks for bringing us the details of that research. Tim Craighead, Director of Research at Bloomberg Intelligence, with those companies to watch. Coming up on the program, one man dominates market expectations for 2025. We will talk you through some of Wall Street's calls for the new year as Donald Trump returns to the White House. What do expectations look like then? That's next. This is Bloomberg.
If you look at Reels, Instagram and Facebook Reels, both immensely popular, both growing a lot. Those are really working not because the short form video format is special and new. It's actually been around for a long time. You remember Vine and the early days of short-form video. It's because of GPUs, it's because of large models, it's because of advancements in recommendation systems. ByteDance is one of the really great companies at this. We also have made an immense investment in harnessing the power of modern models, large data sets, and modern hardware, NVIDIA's hardware and our own hardware, to build recommendations that make the products better and more engaging. Our advertising system is built on modern AI recommendation technology. So I always think it's interesting when people remark that like AI just arrived. It's actually powering already today a huge amount of the engagement and quality of our products.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trade, about 30 minutes into today's session, and seeing a little bit of red on the screen, but not by a major margin. I would say the biggest maybe highlight of the price action we've seen is that futures were higher by 0.6%, and now the Stoxx 600 is virtually unchanged, as is the FTSE. Some underperformance on the continent as well. The French index down by 0.3%. So again, lagging a little bit, but light volume, light liquidity. I mean, I think we've been kind of beating the same drum for an hour and a half.
US futures are still positive.
This is true.
So
let's see for how long.
Let's see how long that lasts, because they look pretty similar to the numbers we were seeing in Europe earlier on.
Today feels like a legacy of last year, doesn't it? It feels like a continuation.
We're not in 2025 yet, which is why I was confused earlier.
Exactly. It's a very difficult day to navigate. But US futures, with NASDAQ futures up by 0.7%, to your point, that's a last year trade. European stocks being a bit lackluster, that's a last year trade, isn't it? So we're still in 24.
Okay, we're still in 2024. 2025 will be starting at some point soon. We think probably Monday. We'll wait and see what happens then. There's a lot of trades that do need to be put on, so people are going to be coming back, looking at their portfolios, trying to figure out what they're going to do. So PMs are going to have a busy start to next week. Let's talk about some of the action that we are seeing in some of the key sectors that we've been watching throughout 2024 into 2025, and also certainly have been one of those sectors. The Chinese EV giant BYD hitting a new monthly sales record in December. This was, of course, spurred on by subsidies and offers of extra incentives to buyers, particularly Chinese buyers. The company says it sold over 500,000 vehicles last month, pushing total sales to 4.25 million passenger cars in 2024. And of course, that narrows the gap with Tesla. We are going to be seeing Tesla reporting numbers later on this week. Delivery targets are going to be watched is it later today? I think we thought it was later on this week, but we're going to get those numbers very, very soon. People are going to be watching very, very carefully to see what happens there. Analysts think Tesla may post its first annual sales decline in over a decade, despite optimism around Musk's relationship with President-elect Donald Trump. Musk has promised that we're going to see a little bit of growth, but it's going to be very marginal whether or not he's actually able to deliver this. This feels like a flat story for Tesla this year. And there's so many contradictory factors around the Musk-Trump relationship, because Trump doesn't feel overly positive on
EV?
EVs, but Musk clearly has some vested interest on being an EV story. But is it
reduced regulation? That seems to be the thing.
I think so. So is Musk? Is Tesla an EV trade, or is it actually a self-driving trade? Which is, to your point, the regulatory trade. Is it a technology trade and a software trade rather than a car trade? I don't know that bit. So in some ways, you can almost win if Trump is negative on EVs, but if he's positive on deregulation, then that could work for Tesla.
Can we also just add to the point that it may not even be fundamental related at all to Tesla? I mean, this is a stock that's seen so much of a move as a part of the Trump trade, as part of kind of the bromance between Elon Musk and Donald Trump as well. And it brings back this question that we saw when Elon Musk was overtaking Twitter, for example, or trying to acquire Twitter, where you saw this inverse reaction with the shares because so much of his personal wealth is in Tesla shares. That had an effect on the entire stock market simply because of the weighting. So if you see this kind of relationship with Donald Trump dissipate, maybe that affects the whole market.
Meanwhile, European car makers and everybody else in this field has to work out, is there a way that you compete with the EV-first companies like Tesla and now BYD? Didn't start that way, but it is now. How do you compete with those when you still have vestiges of the old school, vestiges of the old days and other types of manufacture in your stable as well? It just seems very difficult and very long for European manufacturers to pivot the process.
The story out of China is just subsidies. But Europe feels different. They've also built a lot of charging infrastructure over as well, which is interesting. Europe doesn't have that charging infrastructure yet, which is why hybrids, you look at the Toyota numbers, Toyota is doing much better on the back of the fact you don't have the range anxiety story. But there are plenty of pure EV plays out there that are worth watching. Lucid is certainly one of them. The CEO of Lucid Motors telling Bloomberg that the company's new EV has a range of 450 miles. Does that get rid of the anxiety issue? Now, that was a touch higher than the initial estimates that the company was putting out. Tom McKenzie speaking to Peter Rawlinson on his plans to increase production for a 2026 mass market launch and how this company is addressing supply chain challenges as well.
We're not here just to make high-end luxury cars. This is a complete misunderstanding. We're here to advance technology which will benefit all mankind, and the way we're doing that is addressing the fundamental big-ticket item of building an electric car for a family, and that is the cost of the battery. And that's a function of how big that battery is. Because Lucid's technology enables us to go further with less batteries, it means that we can do a competitive range with much less batteries than the competition, and that will drive the cost down. And that is our commercial advantage. Our technology advantage leads to a profound commercial advantage. So it's always been the plan. We do air and gravity first, and then comes the big one, mid-size, which is scheduled for start of production late 26. And we're readying the factory in Saudi Arabia for 150,000 capacity as we speak, and we'll put that both into Saudi and into Arizona.
Okay, so the mid-size is a mass market proposition.
Absolutely.
For Lucid.
Yes.
Do you think you can get it out before Rivian comes through with the R2? That's also scheduled for 2026.
Yes. I'm not sure what their timeline looks like. Well, let's see. Bring it on.
Given the slowdown in EV adoption that we're seeing in Europe and the US, would you consider a hybrid powertrain at any point for Lucid?
Not for us, no. We're fully committed. I think that battery electric is the right solution. I think hybrids are the worst of all worlds, and I think that hydrogen fuel cells is just a dumb solution.
And would you consider at any point a partner in this auto market to share costs, to share intellectual property? Is that something that's been discussed that you would ever consider?
I would welcome that. I mean, we've already got the partnership with Aston Martin. We're supplying Aston Martin's electric future for their hypercars with our Sapphire technology, and we're in talks at the moment with a couple of OEs for such partnerships. And it would be lovely if we could supply technology to a traditional car company to help them on their way to sustainability, and perhaps we can leverage economies of scale with their parts bin and other aspects of the business. Yeah.
Any conversations along those lines?
Yes, absolutely. We're having those conversations.
We talked a lot about consolidation at the back end of last year, didn't we? That was, of course, Lucid Motors CEO Peter Rawlinson talking to Tom. A lot of consolidation in Japan. what is happening with Honda and Nissan? Is that the way that Europe is going to go? Are we going to see more of that in 2025? Are we going to see some of these big car companies in Europe having to look to partner in order to deliver what customers are going to need at a price point that is comparable with what the Chinese can deliver?
Yeah, and how much of that shows up in the market that we see in the background of some very interesting Wall Street expectations, varied perhaps is the term to use. Wall Street expectations for the year ahead, normally defined by economic statistics like growth numbers, inflation figures, and a host of other dull but worthy indicators. In 2025, the outlook's dominated by one person, President-elect Donald Trump. Bloomberg senior editor for markets all over the story, Sam Potter, joins us this morning. Sam, walk us through the Trump effect.
Yes, good morning. Well, it is uncertainty, in a word, mixed with some optimism. So we know that Trump has spoken a lot about what he intends to do policy-wise, about potential tariffs, about hardline on immigration, but also that he is pretty pro-business, that he is likely to be deregulating rather than adding regulations. So there's this optimism that he can contribute to corporate America and to American growth. But also this, the great unknown of Donald Trump. I mean, ultimately what he's added is this layer of unpredictability to all of the predictions for the year ahead.
Okay, a big picture then. So President-elect Trump looms over all of this. You've done this survey, the team has been doing this survey of Wall Street expectations. What else stands out in terms of this year's collection of outlooks?
Yes, well, every year we gather dozens of these and go through hundreds of calls. And I think what stands out this year is an unusual degree of consensus. Often we do get a broad consensus emerging, but this year there are very few kind of outliers. The overall picture and expectation is something that you were just talking about, actually. A short while ago, you were discussing how the market action today was a continuation of last year. The US futures being up, Europe struggling, Asia down. And that's pretty much the consensus for how things are looking in 2025. US, a lot of expectations for that to broaden now away from just the tech mega caps into some other mid-cap and small-cap names as companies adopt the technology.
Has anybody got anything nice to say about Europe?
Not much, I'm afraid to say. Obviously, we know that there are political issues ahead. France can barely keep its government together. Germany is headed to an election. There is the potential now that Trump is going to introduce trade tariffs that are going to harm Europe's industry. There's not a lot of optimism out there for our region, it has to be said. I think the best that could be said is, given the headwinds, the ECB is expected to be one of the more aggressive banks in terms of cutting interest rates, in terms of being dovish, and that could ultimately help support activity and help support borrowing in the region. But I think it's pretty downbeat when you're looking to rate cuts because of economic difficulties for your kind of silver lining or your upside.
Sam, what are the counter consensus calls going into 2025? I mean, it feels like everyone's talking about the scare factor around Donald Trump. Everyone's talking about this policy divergence on both sides of the Atlantic. What are people calling for that maybe we're not expecting?
So I wouldn't say they're necessarily calling for it, but with the Trump uncertainty, there are a lot of risks being identified, a lot of potential downside scenarios. I think that this AI boom turning out to be a bubble and bursting is one risk that Wall Street has its eye on. Another is government borrowing and the potential for the bond market to finally have enough of these large deficits that so many governments are running. So bond vigilantes is a term that shows up often. But the real big risk and the thing that people are watching intently is exactly how hard and how fast Trump comes in with tariffs and on which countries. Now, if he approaches things harder and faster than Wall Street expects, then there's a very large risk to a hit on global growth, to retaliation from other countries, and an escalation to a trade war on a bigger scale than we saw in his first term. So that's really, I'd say that's the main thing keeping Wall Street awake at night.
20th of January, inauguration, 20 year starts. Bloomberg senior editor Sam Porter, great stuff. Thank you very much indeed. What are we going to do next? Coming up, consolidation. We talked about the car sector a moment ago. It is already reshaping European retail, with more expected in 2025. We're going to take a look at how this sector is going to be getting it together in the year ahead. That's next. This is Bloomberg.
One would be generative AI, and the drop-down box there is the amount of capital that we're going to need to deploy in order to support generative AI. Data centers, as an example. Renewable energy or energy transition would be another of a macro trend. And the drop-down box of renewable energy and energy transition is how do we invest in the infrastructure that's going to allow us to remain competitive in energy transition. The other is, this has taken on a different nomenclature dependent upon who's communicating. It's either onshoring, friendshoring, deglobalization, or what I would call reglobalization. And the reglobalization means how do we invest in U.S. manufacturing? Remember, we peaked in U.S. manufacturing in June of 1979, where 1 in 5 Americans worked in a factory. In the manufacturing base today, that's probably 1 in 20. And much of the dependence that we have in the manufacturing world for all the things that we do are dependent upon the supply chain. The other factor that I would look to is the largest growing population that exists in North America is 65 years and older. And so how we drop down box, how do we engage in healthcare for that demographic? How do we manage the transfer of wealth or not? And the last is cybersecurity.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the opening trade. 46 minutes into Europe's session, and we see stocks in Europe just on the back foot a little, losing some of the early optimism we had, such as it was early on Thursday, the 2nd of January. And now we succumb to the downside just a little. US futures are a little more positive, up by 0.7%, though, I should point out, on NASDAQ futures. And there are some areas of green here in Europe as well. Let's talk about M&A and consolidation. We did that talking about it from a sort of macro perspective in the United States a little bit earlier on in the program. Consolidation is also reshaping European retail, with Zalando acquiring About You, while Frasers and Next in the UK target distressed smaller peers. For more on the trend in 2025, let's bring in Charles Allen from Bloomberg Intelligence to give us his thoughts on how the year is going to shape up. Charles, nice to speak to you. So remind us of how big a theme this has become, because consolidation really picked up during 2024, but maybe we didn't give it the spotlight it deserved. What were some of the highlights?
Well, I mean, probably the biggest one was JD Sport acquiring Hibbett, which sort
sort of took it into not quite a leadership, but a very big position in U.S. sportswear. And that was after a series of acquisitions. And then at the end of the year, it also bought Courier in France. So we saw that as maybe the biggest. There's, on the flip side, there's the one that didn't happen, which was Alimentation Couche-Tard buying 7 & I in Japan. But we have seen quite a lot of movement in the convenience industry, probably off markets, but William Morrison sold their petrol forecourts to a rival, and we saw Asda buy in some convenience stores. So we've seen a lot of movement around at quite a high level, as well as the smaller ones.
A lot of different threads.
Yeah.
Do you think that dynamic's going to bleed into 2025, or is this kind of a 2024 thing?
No, I think it'll continue. I think that, I mean, it's partly because we've got a sort of bifurcation of the retailers in terms of their performance. We've got some people who are doing pretty well, obviously Inditex, Next, and then we've got a lot of others who are sort of struggling along. And in something like online retail, there was so much capacity was built as a result of the pandemic. You've now got overcapacity, and that almost always means that you've got to look for some consolidation to take capacity.
So where's that going to be? What are you? Get your crystal ball out, put it on the table. What are we going to see this year?
In terms of
consolidation, where are the most obvious areas that we're going to see it happening? Any particular names that stand out?
Well, as I said, in online retail, you've got, Zalando's just bought About You, but you've got both ASOS and Boohoo have got very significant shareholdings by various people. And at the moment, Fraser's target was just to say, we want you to change the board, change direction. But traditionally, if a retailer's wanted to do that, it's actually had to pay a premium and then actually acquire the company.
Yeah.
Whether Fraser's will be the one to acquire it, I don't know. But it's difficult to see there can be quite as many small online retailers as there are at the moment by the end of the year.
Tell us about, so some of the deals that you name-checked from last year, Charles, what stood out to me is that there's a lot of cross-border transactions in this space. And I suppose you don't necessarily, maybe there's just so many of them that you don't have to worry about regulatory concerns or any of that sort of thing. But I wondered how you make sense of cross-border retail, because retail can be quite a domestic story, or is that decreasingly the case?
Well, I think on the high level, what you might say in supermarket retailing, people have given up basically on cross-border deals, and if anything, they're still divesting. But in other areas like electronics and fashion, then these things cross borders, and it's your operational excellence and things like that that can do it. And I think that's why we saw Fnac Darty buying into Italy, buying the leading electrical retailer in Italy, why we've seen European retailers in general going back into the US. I mean, I think that there had been a big retreat from Europeans from the US, but not only did we see JD Sport doing that, but we got Fielmann, the German eyewear retailer. It's made 2 acquisitions in the US and thinks it can build a position there. We've got other people doing it organically, but I think we're definitely seeing cross-border, yes.
Charles, nice to see you. Thanks for stopping by to see us at the beginning of the year. Charles Allen. Yeah, Happy New Year from Bloomberg Intelligence on the retail story. Let's turn our attention to what is happening with the central bank story. ECB President Christine Lagarde says the ECB's 2% inflation target is in sight. She spoke during a New Year's address in a video posted on X.
So we have a big, heavy agenda at the ECB. We have made significant progress in 24 in bringing down inflation, and hopefully 25 is the year when we are on target as expected and as planned in our strategy. Of course, we will continue our efforts to ensure that inflation stabilizes sustainably at that 2% medium-term target.
Stabilises sustainably at 2%. Getting the alliteration in there, but can she deliver on the sustainability around 2% is going to be a key question. Let's get more on the outlook that the ECB is looking at with our reporter in Berlin, Ollie Krug. Ollie, that's the challenge almost for the ECB at the moment. While the Fed is struggling to get to 2%, the danger is that actually the ECB struggles to keep inflation at 2%.
Yeah, so listen, Guy, I mean, the expectation this year, we had a couple of prints below 2% this year, but it's really about getting it sort of at that 2%, around that 2% level, sort of sustainably. And if you look at Bloomberg Intelligence in terms of what they're expecting for inflation for 2025, the average in 2024 was 2.4%. The average going into 2025, they're expecting that to be 1.7%. So really moving in the direction that the ECB wants things to be doing. What it then prompts, Guy, is the question of where the sort of neutral rate is for the ECB, and that is going to be a sort of lively debate going into this year. I mean, Bloomberg Intelligence sees it at around 2%. So if you think about the fact that we're at about 3% now on the deposit rate, and we're expecting a cut, another cut, a third cut, and maybe a fourth cut all in a row, that gets you to 2% pretty fast. And the question is then, what are you doing after that? The other thing we need to watch out for 2025 on the ECB is also the Monetary Policy Strategic Review. They're doing another one of these. They did one in 2021. That was the first one they did since in about 20 years, and came from that a new sort of definition of what price stability is. That's where we got this sort of idea that it doesn't need to be exactly 2%. It can kind of overshoot or undershoot through time. So it's really important when they come out with these new definitions. And we're expecting their sort of strategic review on that the back half of 2025.
So, Ollie, what's the risk factor here? I mean, I feel like the spoken but unspoken uncertainty is Donald Trump, but what else?
Yeah, I mean, it's certainly Donald Trump. I mean, let's start with just some of the structural parts of the economy, right? There was a lot of concern from the hawks on services and wages still being a little bit too hot in the economy. It could be sort of pushing inflation up. But actually, all of those figures are kind of moving in the right direction. The other one is energy prices, right? We've been talking about the Ukraine gas transit deal. That's 15 billion cubic meters of gas that's off the market immediately. Again, this was sort of flagged, but it's had an impact on the gas market. We're going to get a much colder January. This is where sort of ECB forecasting and weather forecasting go together, because we've seen those gas deposits go down. That brings prices of electricity up. And of course, the third one is the trade war, right? If there is a trade war between the United States and Europe, there is, of course, that upward inflationary pressure. But there's another side of this coin. If there's a trade war between China and the United States, all of this sort of material, all of these products in China that were destined to go to the United States could actually be rerouted to Europe. And we heard Klaus Knot come out and sort of flag this a couple of days ago, saying that there's a chance that China will start offering their goods to Europe at lower and lower prices. They're already seeing it happening with steel, and in that way, China would be basically exporting its disinflation here to Europe, so potentially a downside risk to European inflation, which would, of course, be potentially good for consumers, but would be really not very good for companies, particularly when they're trying to sort of reevaluate their competitiveness on the global scale.
Oliver, thank you very much. Bloomberg's Ollie Quick, of course, in Germany, keeping us straight on the European agenda through 2025, just as he did through 2024. And we spent quite a lot of time at the beginning of the week, Critty, talking about those comments from Klaus Knot, because it's really important to point out the different ways that the inflation story might be influenced by tariffs in the United States. Because, as he pointed out, if those goods can't go to the US, do they try to find their way into Europe? I think it was Jordan Rochester who was saying that they'll find an even easier path into the UK, and that could be something of a downside move in inflation for the UK to watch.
Yeah, this deflation story, or kind of exporting deflation out of China story, was one we talked about 1-2 years ago, and it was almost kind of put to bed because of this idea that maybe what the US does holds more weight over Europe and holds more weight over the rest of the world. To me, I think what's interesting is that on the European front, it's still a major transit hub. So even if there isn't that consumption factor that you have for the United States, I wonder how much of the tailwind comes from shipping, comes from railroads, comes from, if not using the Pacific, using the Atlantic. How does that work?
If inflation's high in the United States and US yields stay higher, how much of a gravitational effect does that have on the rest of the world? So yes, while we may get deflation coming out of China into Europe, do we import higher rates from the United States?
What does the transmission mechanism
That's the worst of both worlds, isn't it? Slow growth, kind of importing Chinese goods coming in, maybe undermining European the goods story as well. Maybe you then get higher rates coming in from the United. That's a pretty toxic combination.
Yeah, and how effective then ECB policy is in trying to deliver that rate cut.
Absolutely. A massive challenge. Coming up next, I'm going to continue the conversation on The Pulse. We've got a conversation with Citi's head of equity trading strategy, Stuart Kaiser. That's also coming up a little bit later on at 1 p.m. London time. The Pulse is up next. I'll continue. 2025 has started just. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. The top names at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me. But we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought. But I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
In case you missed it, on Bloomberg Open Interest.
We'd love to hear from you. We'd love to hear what you think about our shows here on Bloomberg Television. Do you think we're doing well? Do you think we need to change some things?
Do you like Matt Miller?
Should I wear a wig on a regular basis?
Please write that in. I'm scared.
The first monthly loss for the S&P in 7 months, 30 minutes until it started trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Don't miss Open Interest live weekdays.
European gas prices rise on the first trading day of the year as Russian supplies to Europe via Ukraine stop flowing, ending a 50-year agreement. European stocks, US futures, a little mixed right now. We are working out what is going to be happening in the new year. Chinese shares definitely on the downside. Worst start to a year since 2016. Plus, the US investigates whether there are any links between a suspected terrorist attack in New Orleans that killed 15 and a Cybertruck explosion outside the Trump Hotel in Las Vegas. Let's talk about the markets. I'm not really sure. I'm not entirely convinced that 2025 has started. Switzerland is out today. The rest of Europe is looking very mixed. The DAX is up a little bit. The CAC is down quite a lot, actually, 0.6%. The FTSE 100 is doing absolutely nothing right now. So let's see where else we're seeing some action and what US futures are pointing to. They're a little bit positive, but is that going to change? This is the picture at the moment. S&P futures are up by 0.5%. European futures were up by 0.5% when we came in this morning. That has certainly edged off. Not much action in the US 10-year, euro dollar 103.63. The real action today has been in China. Chinese equities down by, let's call it circa 3%, as we see the Caixin PMI data coming through weak. It's not been a great start for 2025 for Chinese stocks, but let's talk about what the rest of 2025 is going to bring for other markets. Let's get going with that.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome. This is The Pulse. I'm Guy Johnson in London. Happy New Year. Happy 2025. We've already got some action in some key asset classes that we are watching. China certainly front and center this morning. The other area, though, that we are watching is European gas prices. It's about to get really cold, and therefore this really is going to make a big difference. They've risen to their highest level since October 2023 on the first trading day of the year. The reason for this, Russian gas has now stopped flowing to Europe via Ukraine. Now, this has been a route that Russian gas has taken for over 5 decades. Yes, it continued during the Cold War, but it has now stopped. The stoppage will slash Russian revenue by around $6 billion a year and force Central European countries to source more expensive supplies from elsewhere. Priscilla Azevedo-Rocha joining us now on set. Good morning.
Hi, good morning.
We've had this conversation already this morning and talked about what is happening here. Basically, we've seen a transit deal that has lasted 5 decades coming to an end. We knew this was going to happen, though. Talk about the effects, talk about the impact, though, that this is going to have.
Right, so we knew this was going to happen, but the issue is that it happened at a very, very bad timing for Europe.
Yep.
As you mentioned just now, the weather is turning really cold, and the biggest challenge now is to keep stockpiling levels from falling. They have been depleting in the past 2 weeks to the lowest level since 2021, which means that energy usage is increasing, and with colder weather, we see more of this usage. It might not be a problem for this winter immediately, but if we come to the end of this winter with stockpiles very low, it will be very, very tricky for traders from April to start buying gas to stockpile for the next winter, when we're still waiting for most of the LNG projects to come online, so the market this year is looking very tight.
What does Russia do with the gas that would have been flowing through the pipelines?
Well, the gas remains in Siberia.
Right.
They are looking into other routes. They're looking into China, but the capacity is still not there. Russia has sent record levels of gas to China in 2024. It is increasing, but there is still a lot of gas under Siberia.
In terms of what comes next for European prices, do they continue to climb? You said this may not be a factor for this winter, but it probably is a factor going into next winter. The market is a discounting mechanism. It's going to look ahead. Should we just get used to higher gas prices?
It's looking like it, because Europe now is relying on global markets to replenish its storages, which means it has to compete with other places for LNG or for seaborne cargoes, right? So it means that whoever bids the highest gets the cargo. So if China has a very hot summer and it needs gas for air conditioning, they will be outbidding Europe. So Europe has to push the prices higher to attract energy from abroad. So if this is very bad for consumers, this is bad for the industries, because over 2 years since the energy crisis, we're still struggling with very high prices.
Which countries does this affect the most, and how much Russian gas do we still use? Russia still exports LNG gas. Are we still using that here in Europe? So who uses the pipeline gas, i.e. who's been affected by this move, and who's still using LNG shipped gas the most?
Right, so Russia has been increasing LNG shipments to Europe, and this has been a Putin long-term ambition, and we've seen that coming to pass. It's going to ports in France, it's going to Spain, but pipeline gas was mostly delivered to Slovakia, to Austria, and to a certain extent to Hungary and Czech Republic. In those countries, they're landlocked, so they don't have the same access to the LNG that the ports of France, the ports of Spain are getting. So for them to get this LNG to replace these pipeline flows that they've lost, they need to pay transit fees, which will be higher to European countries. Slovakia could access supplies from Germany, for example, but getting from a port in the Baltic Sea all the way through Slovakia would cost more than transiting through Ukraine.
Thank you very much indeed. It's going to be an interesting one to watch. Priscilla updating us on what has been happening here. The team will be all over this story as we work our way through 2025. Priscilla Azevedo-Rocha joining us on that story. Let's turn our attention to one of the big stories we've been watching over the last 24 hours. The FBI says it is investigating a suspected terrorist attack and hunting possible accomplices after a truck was deliberately driven into a crowd in New Orleans, killing at least 15 people. President Biden says police are looking into any possible link as well between the attack and an incident that took place in Las Vegas, which involved a Tesla Cybertruck explosion outside President-elect Donald Trump's hotel in the city.
We're tracking the explosion of a Cybertruck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans. Thus far, there's nothing to report on that score at this time.
Let's bring in Bloomberg senior editor Bill Ferris to talk about this. Bill, what do we know about what has been happening here and the connections between these two events?
Well, we have a little bit more information about that attack in New Orleans that took place just after 3 a.m. local time. Police have identified a suspect in that, a 42-year-old Army veteran who died at the scene after an exchange of gunfire with police. They said in his vehicle was at least one other explosive device and a flag showing support for the Islamic State terrorist group. There's been some reports that his social media profile shows some support as well for extremist groups. And he's from Texas, and investigators are taking their search there. They're calling on the public to offer any tips or any information that could help determine if he had any accomplices or assistants in carrying out this attack that killed 15 people. In terms of the links to Las Vegas and that Cybertruck explosion outside the Trump Hotel there, investigators are being very cautious, saying there's, as you heard President Biden say, there's no clear evidence of a link. One thing that they do have in common is that both vehicles appear to have been rented on the app known as Turo. For those who don't use it, it's kind of like an Uber for people who want to rent out their own vehicles. That seems to be the link, but again, it's not clear that there's any connection between these two attacks.
What does it tell us, though, of the overall security situation in the United States as we head into the inauguration of Donald Trump?
Well, it is going to raise a lot of questions about how such a popular place like Bourbon Street in the French Quarter of New Orleans could be targeted. There is a report from the New York Times that some bollards that normally help protect that area were being replaced and weren't there. That's why there was a police vehicle there instead. But it is obviously always a crowded area in New Orleans. They were scheduled to host a major college football game and parade on Wednesday night. That got kicked to Thursday. We'll see, I'm sure, a very enhanced security presence there. But it also just raises questions about security in other major cities where crowds gather. And of course, one place that will be is in 18 days in Washington, D.C. for President-elect Trump's inauguration. I'm sure there's a second look at security procedures there going forward now.
Bill, great stuff. Thank you for the update. We greatly appreciate it. Bloomberg's Bill Farrad is on what has been happening in the United States. Coming up, we're going to talk about what is happening on the other side of the world. Chinese stocks posting their worst start to the year. Nearly a decade, investors are bracing for economic certainties this year. The Trump factor is certainly part of this discussion as well. We're going to discuss the outlook for Chinese investors and global investors into China next. This is Bloomberg.
Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays only on Bloomberg.
I'm looking at 2025 being the year of the great pivot.
And by that I mean I think China is likely to outperform the US.
Uncertainties abound. And I would say it is, I think, very important for China to tap the policy space more ambitious, more aggressively and effectively.
I'm a little bit concerned as to the durability of the Chinese consumer amidst some of these, a weakening external outlook as well.
What I'm looking for is a sudden jolt or one other sudden announcement with the emphasis on money in the pockets. That will really cheer me up.
The next 12 to 18 months in China for investors based in the U.S. could be a bumpy ride, but for investors who have 3- and 5-year and longer time horizons, then you have valuation on their side.
So our guests giving their outlook for China this year. A lot of uncertainty, I think, is probably something you can take away from that series of clips. Chinese stocks posting their worst start to the year in nearly a decade this morning. Weak economic data, the Caixin, certainly not pouring a great deal of good news onto the Chinese market, and maybe we've got a lot of bad news. We've got the prospect, of course, of US tariffs coming through. We're waiting for the 20th, the inauguration of Donald Trump. There's a lot going on. Eric Nelson, macro strategist at Wells Fargo, joining me around the table. What's your degree of certainty on the China outlook this year?
About as low as usual. To say very low.
Yeah.
I think what's unique about China is that the ingredients for recovery can be there. You just need fiscal to step up, and that's been the case for years, and we haven't seen it.
Yep.
Right? There's the rhetoric we've heard from China in the last few weeks has been better, but it still has not been matched with actual details, and certainly not with actual actions. So I can make a positive case for the China in 2025. It just has to have that fiscal piece there. So until we see that, we're not yet super optimistic, but I certainly can see an upside risk scenario.
Does China have to do something dramatic in order to deliver the kind of change that people are hoping for? At the moment, we seem to be doing everything very incrementally, very low-key, not creating waves. Is that something that at some point may have to come to an end, and waves need to be created, and big waves potentially at that?
Sure, yeah, it's a scale problem. The numbers, to your point, we're talking about here, 0.5% of GDP here, 1% of GDP there, spread out over this many years. You need direct action, needs to be big, 5, 6, 7, maybe 10% of GDP.
So what does that look like? Is it a big devaluation? What macro effect will that have? Are they really capable of delivering big fiscal? If they're not capable of delivering big fiscal, what else is on the table?
I think devaluation is not the answer to China's ills, right? And my concern is that will continue to be the lever they pull, because there's this never.
So it is a risk.
It's a risk, yeah, absolutely. Especially if you see escalation in tariffs from the U.S. side. China needs something to offset that, and there's been this continuous focus on the supply side, right? That's been the main focus. Until that changes to demand side stimulus, I think there is fiscal space for China at the central government level. Yes, it's all kind of one big system, and the local governments are sort of backed up by the central government. I get that, but I think there is fiscal space. The bond yields are telling that story. That needs to be demand focused, not supply focused.
If they went for the lever of a currency devaluation, how do you think Donald Trump would react to that?
Not well.
No.
Not well. Yeah, I mean, we know how he feels about the dollar. We know that the whole thesis behind putting tariffs on China is to try and offset and sort of undo some of these imbalances between the U.S. and China. A devaluation is just going to put us back to square one.
So basically it would offset the tariffs. So potentially you would need more tariffs, or you would need to do something different.
Effectively, yeah.
Given all of that, how does this year play out? If you're sitting here, you're a PM, beginning of the year, trying to figure out what is going on. Those are really big tectonic plates you're talking about moving around here. How easy is it to deliver a clear idea at this point of what 2025 is going to look like?
Well, I think it's important to understand their starting point here. What does the U.S. economy look like going into this, right?
Yep.
I wouldn't say it's super strong, right? Manufacturing and construction are the two cyclical indicators, or parts of the economy that drive the U.S.
Yep.
Neither one looks particularly strong right now. Manufacturing's declined 3 months in a row. Construction's weak. That worries me a little bit. Not where I'm saying, there's a recession on the horizon in the next 3 months, but you have these cyclical parts of the U.S. economy saying, if you get this kind of trade war escalation, dollar gets much stronger, you're pushing it into a already somewhat precarious U.S. economic outlook with some of these risks.
What you may end up happening in the kind of scenario that you're talking about is it's not super strong, but it's strong. The Fed doesn't need to do a great deal. Does it need to cut? Maybe a little bit, but not by much more. But you've also got a 10-year that's that's going up. The curve is steepening quite a lot, and last 3 months I think the 10 years up by what, 75 bips or something like that. What happens if that trade continues?
That's a problem. And, you know, the housing, like I mentioned, the housing market, construction market has already come under pressure. Mortgage rates creeping back up towards 7, 7.5, maybe even going back to 8 if you see this move keep going. That's a real problem, right? This is what drives the economy here, is that, you know, long end of the curve in large part in the residential sector. So that worries me. And to your point, the steepness, you know, the bear steepening of the curve, very, very confusing and very sort of worrying. When a hawkish central bank comes through, like we had the Fed at the end of in the middle of December, the curve is not supposed to steepen, right? And the fact that the 10-year sold off more than the 2-year, that tells me something is not quite right here.
So does term premium get greater?
Could, yeah, could very well do. I mean, and you look at the dollar funding market, you know, repo market, still under some pressure, and that I think is playing into this continued pressure on the long end of the curve. So it's not a particularly encouraging sort of plumbing situation within the U.S. repo and treasury markets, and that is kind of lurking there in the background.
Heard from Christine Lagarde over the holidays on X talking about the fact it's pretty comfortable, 2%, we're going to get there, it's all going to be good. How big a challenge is the ECB going to have keeping inflation at 2%?
I think, yes, certainly a somewhat difficult time. I do think, though, for the ECB that the problems are very much both on the growth and the inflation side. So inflation is still above target. It's kind of, you know, services inflation is kind of sitting, you know, too high. But growth is also looking a little bit, you know, weaker. And Germany in particular, France is not doing particularly well. And employment markets there are starting to weaken. Now, this is not the flexible labor market in the U.S. where you're worried about mass unemployment. But, you know, the ECB doesn't have a dual mandate, but they have to start worrying about the growth side as well.
And what does that mean? So we're going to hear a lot about gradual, do you think? Is the word of the year 2025 from the ECB's point of view gradual?
It is for now. I think that could certainly change. And I think it's the same can go for the Fed. Frankly, we have more cuts for the Fed than what they penciled into their dots for 2025. Not much more, but, you know, the central bank's getting more hawkish, ironically, could mean more cuts down the road.
Right, because in the near term you get the effect of that hawkishness coming through.
Activity, exactly.
Okay, so we end up. So how big could the gap between across the Atlantic get? Well, what would that mean for euro dollar? We're at what, 103 now? Yeah. Upside downside risk on that? Like, have we priced in most of kind of what we know at the moment already into that 103, or is the downside risk to that 103 still there?
No, I think we priced in quite a bit of the risk. And you look at just in the last 2-3 weeks, some year-end sort of dislocations happening. Euro's trading much lower than where rate spreads have gone in the last 2-3 weeks. So maybe it's a little bit cheap to rates right now. I think what is key for me is what happens between the U.S. and China on trade, and also the U.S. and Europe on trade, right? Yeah. We know the U.S. has just talked about German autos. So there can be more risk premium in euro dollar, and in the sense of we can go through parity if, you know, you see widespread tariffs put in place on Europe, on China, China devalues like you mentioned. There's certainly lots of risks that can get us below parity, absolutely. But right now, as we sit here today, I think there's some room for maybe at least a tactical recovery into the inauguration.
In terms of this year, do you want to? We have run through a lot of risks here. Often we talk about the risks at the beginning of the year. Some of them materialize, some of them don't. Does this year feel like a year in which more risks are going to materialize? There is going to be more volatility, and therefore, in many ways, I want to take less risk this year than maybe I took last year.
Certainly the conversation we're having with a lot of investors, right? It's been a fantastic 2 years for assets of all kinds. Yeah. And, you know, the growth backdrop looks a little bit shakier than it did, you know, the beginning of last year. And I also think that, yeah, the geopolitics is less predictable by its inherent nature. Yeah. And so much of the outlook rides in that this year. So I think there's a lot of caution out there going into this year.
It's going to be a fun year. Eric, nice to see you. Thanks for setting it up for us. Eric Nelson, macro strategist at Wells Fargo. Coming up, Citigroup and Bank of America are the latest U.S. lenders to leave a global climate banking group. We'll have details next. This is Bloomberg.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Morning from our world headquarters in New York. I'm Manus Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bit of news in the banking sector. Citi and Bank of America are to leave a global climate banking group. They are the latest lenders to exit the Net Zero Banking Alliance. The bank's departure comes with Wall Street under pressure from Republican lawmakers to distance itself from industry groups that support reducing carbon emissions. The NZBA is part of the Glasgow Financial Alliance for Net Zero, which is co-chaired by Mark Carney, who is the chair of Bloomberg Inc., and Michael Bloomberg, who, of course, is the founder of Bloomberg LP, the parent company of Bloomberg News. As we digest that news, I want to take you to Seoul, where crowds of supporters are currently gathering outside the impeached Korean President Yoon's residence. The Constitutional Court in the country is set to decide whether he will be permanently ousted after being impeached for declaring martial law in December. We'll continue to monitor these pictures. This is Bloomberg.
There is no backwards in recycling. There is no backwards in treating pollutants in the water. The trends at times of what you talk in the press may be different from one crisis to the next. My job is to go beyond crisis, to anticipate. That's why innovation. We knew we could do recycling of plastics. For years, nobody was really interested in that. And suddenly, it takes off. But we found a solution in the meantime. So in a way, my job as a chief exec is to deal with the short term and to be able to deliver essential services, even in time of crisis, as well as to see the long term and deliver good result, of course, for my shareholders. Because in a way, delivering good results now is a way to afford the future and to afford to innovate and to see the long term as well.
Top names opinions at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me. But we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning. Welcome. Day 1, day 2 of the new year. This is The Pulse. I'm Guy Johnson in London. Let's update you with your top stories. European gas prices rise on the first trading day of the year as Russian supplies to Europe via Ukraine stop flowing, ending a nearly 50-year agreement. European stocks a little mixed. US futures a little more green at the start of the new year. Chinese shares, though, have seen their worst start to the year since 2016. Plus, the US investigates whether there are any links between a suspected terrorist attack in New Orleans that killed 15 people and a Cybertruck explosion outside the Trump Hotel in Las Vegas. Okay, let's talk about the year ahead. Let's figure out what we should be expecting, what we should not be expecting. As ever, we are deluged with a series of reports which tell us what we should be looking for in the year ahead. Bloomberg has fantastically collated these and tried to figure out what the consensus actually looks like. Wall Street's expectations for the year ahead, normally defined by economic statistics, of course. We normally look for things like growth and inflation and what price-to-earnings multiples will ultimately look like. These are good. They're fantastic. I'm a big fan of these kinds of indicators. 2025 looks a little bit more touchy-feely, though, because we are going to be seeing the year, I suspect, dominated by one person, Donald Trump. His impending return to the White House hangs over almost every word of the key calls from financial institutions for 2025. Politics is a less precise science. Fortunately, Bloomberg, though, has been through all of these reports. Let's figure out what we should take away from them. And Justina Lee joins us around the table now with more. What is the key takeaway, apart from Trump?
Well, interestingly, it seems to be, more of the same. I mean, there's kind of this consensus across Wall Street that even after the incredible rally we've seen in U.S. stocks, you can expect more of that. U.S. exceptionalism, still put your money in the dollar in U.S. stocks. And I think that's really interesting because in the past, we might see a bit more mean reversion in kind of these strategist calls. But at this point, they're kind of, I think maybe after the experience of the past few years, they're like, valuations are high. But at the end of the day, there seem to be good reasons for why you should still keep your money in U.S. stocks.
The problem with it is that basically portfolio managers keep trying to change things and keep getting burnt. And basically, therefore, the safe trade is to basically say things carry on as they are. But you get down to the bottom of the report that you compiled and you look at the risks. And I kind of read through the risks. One bank says the U.S. economy is too hot. One bank says the U.S. economy is going to cool. One bank says it's too hot. One bank says it's going to cool. One says the Fed's going to be cutting. Another one potentially says the Fed is going to be hiking. What's the degree of certainty? And is it higher or lower than it would normally be?
Well, I think that, the big question here, of course, is Donald Trump, because another consensus across these reports is that if we do get some degree of tariffs, they're going to be inflationary. They're going to be, negative for the U.S. economy. So it seems like people are expecting, the positive outcomes from tax cuts, from deregulation to outweigh those. But at the end of the day, I mean, if you really do get kind of tougher tariffs and, an immigration crackdown, I mean, the consensus is that is inflationary. So that probably means, less rate cuts for the Fed or even kind of a pause in this easing path. And that seems like bad news.
The equity market, the S&P has done 20% last couple of years. What is the consensus for next year? As rosy as it has been? Is it, you've been doing this a while, you've kind of got a sense of how the market's feeling about things. Are people convinced that we're going to see another 20% year?
Well, not so much. So people are expecting maybe lower returns than that. But another kind of interesting call out there is I guess that is more the valuation play, which is that are we going to see a rotation into small and mid caps because of U.S. deregulation, or kind of into more of those value sectors? Now, that's something that strategists have been calling for a few years, and we haven't yet seen a sustained rotation.
We saw a bit of it at the end of last year, but it didn't stick.
Exactly.
So is there an expectation that it comes... The broadening market thesis has been around for a while, but the AI trade still comes... Do you think people are scared of stepping away from that? Because that's where the money has been made.
Yeah, and I think there's a sense that maybe it also reflects changes in the underlying economy. I mean, the tech world is winner takes all. And at the end of the day, I mean, these tech giants are kind of almost monopolies in what they do. They kind of combine many different businesses. They have great balance sheet strength. So it can feel like it's both a growth play, but also a defensive play. And I think that just makes them kind of almost safe investments, interestingly, to a lot of investors.
Is there a lesson that we can... Are people worried about expectations being too high? And the reason I ask this question is Novo Nordisk got battered at the back end of last year. It was a stock that kind of is the perfect example of this. A stock where expectations got very high, were delivered upon, and then a tiny chink in the armor, and the stock gets knocked down pretty hard. Are people expecting a lot of volatility around some of these big names? How bumpy a year is it going to be?
Yeah, I mean, that's a great point. I mean, Bank of America said the biggest tail risk out there is AI, and Magnificent Seven turns out to be a bubble. Of course, kind of the good news now is if you want to hedge, I mean, you have kind of bonds paying out pretty good rates. I mean, you have the volatility markets, so, you know, pricing in pretty low volatility. So if you want to hedge via options, that's pretty cheap. And of course, if you want to buy into low expectations, Europe and the UK are always kind of your play there. So we do have a few calls saying, you know, maybe Europe will surprise to the upside because the bar is pretty low for that.
I feel like I've heard that before, and it continues to disappoint. Justina, thank you very much indeed. We are going to continue to monitor these. I suspect the year is going to start on January the 20th when we get Donald Trump coming in, and we'll start to get a better idea of what this year is really going to look like. Bloomberg Intelligence has compiled a list of 50 companies that we should be watching this year. AI, exposure to China, some of the big themes that the BI is watching. Tim Craighead, Director of Equity Research, joining me around the table. Let's talk about the year ahead. 2024 was a U.S. year. Is 2025 a U.S. year?
Well, it's the biggest market cap. It's the biggest percentage of those 50 companies that we have on our list, but that's just natural that you would expect. We do see better growth in the U.S. We do have a constructive view, broadly speaking, on the U.S. markets if you look at what Gina Martin Adams is thinking. But it is reasonable to consider those concerns that you've brought up. Momentum works fantastic until it doesn't. And we all know that stocks go through life cycles of value to growth to momentum. And momentum is fantastic until, as you mentioned with Novo, you have a slight disappointment, even if it's a fantastic absolute number. The disappointment kills you if valuations are high. And that's one of those things you have to keep in mind.
In theory, we should see mean reversion. In theory, the markets that have been beaten up should bounce back. Europe, China. Is that the trade for this year? Like, if you're looking to diversify, manage your risk, do you look at these other markets, or are you going to be punished as a PM for not just taking on board the U.S., sticking with the U.S.? Why take the risk of moving money elsewhere?
Yeah, well, I mean, that is the $64,000 pound euro question. And I would agree with some of the commentators that you've had on the program this morning. You can't walk away from the U.S., but there's too many compelling opportunities, part of which is valuation driven abroad, if you can find ideas where there is a catalyst that you think, that you feel compelled, can change the market's mind.
So talk to me about China. What do you see there?
Yeah, so our view for 2024 and 23 was very much oriented towards the property crisis and risk. Our view this year is more constructive. We do think stimulus will come through. It has been incremental so far. We're waiting on a big bang. We think more will come. So China wealth flows out of property into other markets is a big deal. HSBC is a really interesting story, as is CITIC Security in China. Consumption, we do think, will come back. There's a number of Chinese consumer brands that are quite interesting, but there's also European plays into that. Remy Cointreau would be an example. Travel will continue to pick up. Airbus has a huge business in China. There are a lot of ways to play this and steer away from property.
Let's come back to Trump. Look at your 50 stocks and talk to me through the Trump effect on those stocks and how he, as president, is going to have an impact.
Yeah, so we would say, number one, tariffs are out there, as you've talked about. We don't think tariffs happen this year. We think it's more of a bluster, and it's a negotiating tactic. He loves a deal, and so we would agree with Bloomberg Economics. That's more of a late 25 or 26 issue, notwithstanding talk. So what do you focus on with China? You think about stimulus, and with Trump, you think about stimulus because of tax cuts and deregulation. Those things can happen very quickly. And there you've got any number of ideas that play into economic growth. Adecco is an employment story. Signify, the world's largest lighting company, has a big U.S. business to see housing starts, renovation, other things like that play through, along with a number of core U.S. companies that range everything from Tapestry, which owns Coach, to Workday, which is an employment-related story in the software world. Emerson Electric is a big diversified industrial that's a play in the U.S. just from purely better economic activity that we think will likely come through.
It's going to be interesting to see what happens this year.
Yeah.
We will come back and look at this 50. Tim Craighead, Bloomberg Intelligence Director of Research. Thank you very much indeed. Coming up, we're going to have more of our recent interview with the Unilever CEO on his turnaround drive at the company and the possibility of higher trade tensions with Donald Trump in the White House. We will do that next. This is Bloomberg.
You missed it on Bloomberg Open Interest.
We'd love to hear from you. We'd love to hear what you think about our shows here on Bloomberg Television. Do you think we're doing well? Do you think we need to change some things?
Do you like Matt Miller?
Should I wear a wig on a regular basis?
Please write that in. I'm scared.
The first monthly loss for the S&P in 7 months, 30 minutes until it started trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Don't miss Open Interest live weekdays.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
Welcome back. Unilever began a turnaround drive back in 2023 with cost-cutting measures, including headcount reduction of more than 7,000 jobs. Its CEO, Heinz Schumacher, recently spoke to Francine Lacroix about everything from consumer spending, premium demand, to the possibility of new trade tensions coming back as Donald Trump returns to the White House.
Yeah, I mean, tariffs and protection is always disruptive for businesses that operate globally, and I recognize that. But hey, if it's a reality, then it's a reality. I think what we have been doing over the last few years is, in general, after COVID, we have made our markets, in general, more self-sufficient. Right. So if you look at, for example, our China market, it's essentially self-sufficient. India, for sure, is. The US is mostly self-sufficient, with some imports, though, from Mexico, but that is not material to the group. It's not significant. And we have a fairly agile supply chain that, if the situation, if it comes to that point, that we could reallocate our production from those factories to other parts in our network and make the US probably even more self-sufficient. So, hey, we are adapting fast, we're agile. It's not of material impact to the group, but we're obviously watching it very, very closely.
I mean, does it influence your decision on where to cut jobs?
No, at this point it doesn't. No, we have made an announcement on a restructuring program that you're probably referring to in March. 7,500 people, because we felt that was for two reasons. One, we are making the organization ready for a Unilever without ice cream, and that needs to be a lighter organization. And we wanted to be ahead of that demerger and take measures now. So that was reason one. And reason number two, we have changed the structure. I talked to you about strategy and structure. We've changed the structure to be faster, to be able to scale these brands faster across the globe. And when you do that, you need to take the consequences that, hey, it can be a bit. We can be more efficient, and that's what we're doing.
But you worry about unfair advantage for some of your competitors that are based in the U.S.
Yeah, our competitors. We are based in the U.S. The U.S. is our biggest market.
You're not headquartered there, so someone like Pepsi, do they have an advantage under Trump if he puts America first?
No, I don't think so. I think we have been in the U.S. for decades. We could, it's our largest market. We have phenomenal US-centric brands. I talked about Prestige Beauty, but also brands in well-being, such as Liquid IV, such as Olly on the VMS side and on the well-being side. So, we are in many ways, in that market, we are an American company, and I believe that the US government has every interest to work with companies from overseas who are active in America to promote investment in North America, to care for jobs, to do the right thing for that market, and that's what we're doing.
So you also divested, of course, what you had in Russia. Maybe some of your US competitors won't have to going forward. Was it a mistake to get rid of it?
Russia was something that was a very difficult decision to make. I found that in my last 1.5 years, it was arguably the most difficult decision to make. But I did make it quite soon, in the sense that I wanted to create optionality for us to exit that market, and that was a tedious process. So it took us more than 12 to 14 months to come to that point that we were able to exit. And at some point in September, I felt I had the optionality on the table. And it was difficult, but I made the decision to go, not because of the war that's going on right now, but because I felt that the control on our business was coming down. I feel that ultimately, if you're a global company, you need to have control of your operations. We need to be able to review results. We need to be able to get the cash out of the country, ultimately. We need to be able to make sure that we live up to potentially international sanctions. We need to be able to control our brands and where our brands travel. And that was something that I felt wasn't enough anymore, and I didn't see a window into the near future where we would regain that control, and that drove the decision to exit.
And talk to me about Ben & Jerry's. So the way that Ben & Jerry's was set up was also having an independent board. Will that still be the case going forward, given actually, a lot of the questions that you've just been telling me about?
Yeah. No, Ben & Jerry's has an independent board, and that independent board that that looks after the social mission of Ben & Jerry's only. So it's not a board that looks at the business side of Ben & Jerry's, because that's what we do, but it looks after the social mission that's there. That was agreed at the time that Unilever acquired Ben & Jerry's. It's in the merger agreement, and we absolutely respect that merger agreement. And therefore, the new ice cream company that will be demerged will respect that merger agreement.
Is it tough when, you know, the politics gets into selling products?
You know, I think, I mean, in the case of Ben & Jerry's, look, that brand, we acquired it, I think, at a sales level of 120 million or something like that, and we've grown it to a more than $1 billion brand. It's been growing very successfully, and part of the success of Ben & Jerry's is a social mission. And the way they speak out and the way they speak up, and as long as that fits, you know, the brand, peace, love, and ice cream, I'm all for that. It's a wonderful thing to do. You need to be careful that, as a company, that you don't take political sides when that's not necessary. So, you know, sometimes that brings a certain tension, but I believe it's a healthy tension. They keep us on our toes, and it's a great brand. I love it, and I'm sure it will be successful going forward.
That was, of course, the Unilever Chief Executive, Heinz Schumacher, speaking with Bloomberg's Francine Lacroix. Coming up, we're going to come back to what is happening with the central bank story in 2025. Christine Lagarde welcoming the new year, saying that the ECB's inflation target, 2%, remember, is in sight. So we are going to look at what lies in store for the single currency over the year ahead. That is next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Romain Bostic in Detroit, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back. So the ECB's president, Christine Lagarde, says the central bank's 2% inflation target is in sight. She spoke during a New Year's address in a video posted on X.
So we have a big, heavy agenda at the ECB.
We have made significant progress in 24 in bringing down inflation, and hopefully 25 is the year when we are on target as expected and as planned in our strategy. Of course, we will continue our efforts to ensure that that inflation stabilizes sustainably at that 2% medium-term target.
Stabilizing sustainably at 2%. Let's get more on the ECB's outlook and what inflation is going to look like within the Eurozone in 2025. Let's have a conversation with Bloomberg reporter Ollie Crook, who joins us out of Berlin. Ollie, growth and inflation, two big challenges for the ECB. What indications are there that the ECB can sustainably stick to that inflation target of 2%?
Well, listen, if you look at the forecast in terms of what we're sort of expecting going into 2025, when we look at the average rate of inflation in 2024 is about 2.4%. We're expecting that now, according to Bloomberg Intelligence, to come down to 1.7%. That is basically right in the range where the ECB wants to see things going, and a lot of pressures are going in the direction that basically confirm what Lagarde is looking for. What that means in terms of the outlook, in terms of what we're expecting from the ECB, that means that we're expecting a cut in January, a cut in March, a cut in April, maybe a cut in June as well. That's 4 consecutive cuts. That could take us pretty close to what Bloomberg Intelligence thinks is the neutral rate, which is a 2% deposit rate. We're at 3 right now. You could get down to 2 pretty fast into the beginning of the year, and that will sort of exhaust your cutting if that is about as far as you're going to go. And that is going to pose some real questions in terms of what is going to happen in terms of growth. Can there be more stimulation that could happen there from the ECB? But the other thing we need to watch out for, Guy, in the back half of the year is the monetary policy strategy review. This is going to be the second one that they've done in a couple of years. The last one they did was in 2021, and that was the first they'd done in about 2 decades. And in that policy review, they had a new definition of price stability, and that is when the ECB went from a 2% target to a kind of floating 2% target, i.e. you can overshoot and you can undershoot for periods of time, which is significant when you think about how much influence the ECB has over these markets and basically what goes into their thinking. So we're going to see what they have to say in terms of the updates going forward for what their strategy is going to be.
There seem to be many things that could knock the ECB off course, though, this year.
Yeah, listen, I think that one of the sort of structural issues that people are talking about, the hawks, are wages and sort of the services side of the economy. Those indications are actually pointing in the right direction. But when you look at energy, you look at this sort of Ukrainian gas transit deal, for example, that's 15 billion metric cubic meters of gas that's off the market overnight. Again, that was sort of expected and priced in, but that bears on energy prices, that bears on inflation. But I think the big one, Guy, as we've been talking about for a long time, is that trade war, not only with the United States, but if there's a trade war between China and the U.S., what happens to all that excess capacity in China? It comes right into the European market, and that's exactly what Klaus Knot has been warning about, that basically China could be exporting deflation to Europe if the trade war between the U.S. and China escalates.
Ollie, it's going to be an interesting year, a bumpy year potentially for the ECB. Thank you very much indeed. US futures currently pointing to a positive start for this new year. We're up by 0.7% for the S&P. Up next, The Brief. Danny Berger, Manus Cranny, back together in New York. This is Bloomberg.
thoughts on fast fashion? It's been transformative. It gives the masses access to fashion, but there's a cost to it, downside to it.
My first insight is too much waste. I think this is also how I grew up, making your own clothes and making something that's well special and well unique. It's like timeless. And now you see that everybody is looking the same, like wear sweatshirts and wear T-shirts. And for me, it's just like when they wear something that's special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing, everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough, to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using the sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, it's really important to really make it happen. Every collection, I think about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Crenny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
On security alert, the FBI investigates a potential link to terrorist groups after a deadly attack in New Orleans. New Year's rebound. Markets kick off the year with tech leading futures higher after a year-end slump. And Nippon Steel ramps up its effort to win approval for its takeover of U.S. Steel. Good morning, Manus. Happy New Year.
Danny, good morning. Happy New Year. Day 1. And we'll risk on for now. The question is, will that endure? We're shaking off the shackles of the longest losing streak to the end of the year since 1966. I think the UK won the World Cup that year. The Russell crashed by 8% in the month of December, the worst month since 2022. We're bounding higher by 0.5% this morning, but it is tech that leads the charge. Roll it over, have a look at the bond market, because, of course, bonds were the tortured souls of returns of 2024. They delivered a loss of 0.6% for 2024. They gave a huge amount back in December. It's up in yields for 4 years in a row. That's the first time we've seen that. Deutsche Bank talking about that this morning. Term premium is up. Is that enough to bring you in at 4.54% in the bond markets?
Meanwhile, we got a couple equities that we're keeping our eye on your first trading day of 2025. Tesla, one of them, it's going to be delivering its 4th quarter sales later this week. Shares are moving higher in the pre-market, more than 1%. BYD sales also came. Those hit a new record.
MicroStrategy surging as Bitcoin kicks off the new year after a record-breaking 2024. And President-elect Trump prepares to take office.
Meanwhile, Alphabet getting a downgrade this morning to perform from outperform at JMP Securities. Analysts saying the possible impact of antitrust penalties on Google revenue streams. Those shares still moving higher pre-market, Manus.
In just a few moments, we'll set your agenda for the start of 2025. Where to put your money. Dan Morris, BNP Paribas Asset Management, joins Danny and I. And then Sonia Meskin of UBS will give us the economic roadmap. Danny, good morning. We're counting down to the inauguration of Donald Trump Trump. And in that first 100 days, it's going to define, in many ways, the angst that we've talked about a great deal into the close of 2024.
But how reactive will markets be? Because so far to any tariff news, be it the Panama Canal, be it Canada, be it anything, markets haven't been reactive. Maybe we're more humble this year after literally getting the past 5 years wrong, going into it, be it COVID, be it inflation, be it a lack of recession. We keep getting these calls wrong.
Look, 100%. I think the question of the sequencing, when does the tax bill come through? So a lot of the euphoria, 24% up in the S&P 500, how much is that predicated on the Fed? How much of that is predicated on the tax policy that's going to be enacted as he comes to power?
Well, we almost had a government shutdown to end the year. Let us not forget the quarrels that we had in Congress. Congress starts very soon, the new double chambers of both Republicans coming in. Already, though, it's clear that there's a divide, even though they have a majority. How easy will it really be to pass some of Trump's priorities?
Well, there's 38 rebels out there. They showed their teeth just before Christmas. Will they do that again? Let's put this all together. We've got Dan Morris kicking off 2025 with us this morning from BNP Paribas, and this is what he says about markets. They should eventually have all priced in, all the good news for U.S. equity markets and bad news for Europe and China, at which point the U.S. may disappoint and the other markets surprise. We are likely not at that point yet. Dan, good morning. Good to see you. We're kicking off with a brave bid to these markets this morning. So for you, as you start 2025, do we still remain in a period of U.S. divergence and exceptionalism? That remains intact for now. Will it endure for the whole of 2025?
Well, I think that's the important distinction. Danny pointed out how, in general, we've all been wrong over the last 5 years in terms of predictions, and I don't know that's necessarily what we're here to do. I think as an investor, you're trying to look at this point in time, how do you want to be allocated? What's the optimal allocation? And we do think that is still an overweight to U.S. equities. That said, you're constantly evaluating that position, looking at the different scenarios that you had to have ahead of you, and seeing if you're moving into another scenario where maybe that's not the best allocation.
Just looking at where returns for this equity market, total returns came from over the past year. About 1% came from dividends, about 10% came from higher stock valuations, about 13, the final 13, came from rising expectations of earnings. Dan, in those buckets, where can we juice further returns from? What looks like it can keep growing?
Well, I think we want to look primarily at the earnings expectations, and two things to keep in mind. I mean, we appreciate, especially at the beginning of the year, you have analysts that tend to be fairly optimistic, and you have pretty robust year-on-year earnings growth forecasts, and you can argue that once the year starts, the EPS estimates tend to fall, and that's fine as far as the equity markets are concerned. You want to focus on what's going to be the absolute return. So even if we don't quite get, say, 20% earnings growth for NASDAQ, the way analysts might suggest, if it's only 15, then clearly, well, not clearly, likely markets will do well. So we want to keep those two things in mind. Yes, there may be negative revisions to that outlook if things aren't quite as positive, but if it's positive earnings growth, that's really going to be what drives the market.
Well, Dan, that's the equity side of the bucket. Let's talk about the bond side of the bucket. I want to come back in another life as a high-yield treasury because, I mean, that's where there was real delivery, 8% overall for 2024. And treasuries themselves lost just under 0.6%. When you look at the bond market, the low bar that I see in front of me for performance in treasuries is there. How do you look at this bond market going into 2025?
Well, frankly, we're still in the range that we've been in for quite a while, anywhere from 5 at the top, and we were at 5% in October 2023, if I'm not wrong, to low 4s for this year. So we're still in that range, and I think that reflects, honestly, what is still a significant amount of uncertainty about where things could go from here, and much more impactful, honestly, for fixed income than necessarily for equities. So on one hand, if you do have much more growth, higher inflation, that would argue for higher treasury yields. At the same time, if you have policies that turn out to be negative for growth, you can see yields fall. Now, clearly that's not particularly helpful to say yields could go up or yields could go down, but I think that does explain why you've had relatively little, honestly, volatility in fixed income because of that uncertainty.
Dan, let's put these two things together. For asset allocation in 2025, in a moment where equities look to be maybe the strong place, but valuations are unusually high, when we could have the volatility that you're talking about in this bond market, but real yields are basically as high as they've been in the past 15 years, what does the balance look like between risk-free assets and risky assets in 2025?
I mean, we are marginally overweight equities, so we think that's a better place to be, and to U.S. equities. So, again, constantly evaluating that allocation, but from our point of view today, that seems to be the best way to allocate.
We've just had a brief chat, Danny and myself, about the 38 holdouts in the continuing resolution just before Christmas. How important is it for exceptionalism, U.S. asset outperformance, that we do understand what the tax roadmap is a little bit sooner than the back end of this year? Because that's the deliberation, whether they go for energy and immigration and defense in one bill and tax in the second bill. How important is the choreography to you, Dan?
Well, it certainly would be significant. At the same time, we want to remember that generally politics don't matter that much to the economy and the markets. Really, it is what the Fed does that's going to be more impactful. That said, when you do have single-party control of government, that's when it can matter a lot more. So the details are what's going to count. We, like everyone else, are waiting to see at least a bit more what those details are going to be. We're waiting for the inauguration, and then the markets will have to reassess what they think the path forward is after that.
Then, Dan, is this year different? Is this a different year in which the politics does matter, and maybe what the Fed matters less?
I think it'll be like it was, say, the first part of the Obama administration when you had Democratic control, first Trump administration when you had Republican control. Those were exceptional years insofar as on a relative basis, you're right, the politics did matter more. I think that will likely be the case this year, but at the same time, we certainly don't want to forget what the Fed is doing.
Do you think, Dan, that there'll be moments of high volatility in equity markets? We've used this phrase before Christmas, of exuberant corrections. Is that part of the landscape of this year? Because the politics are going to cause air pockets. We've seen them before. We have precedent.
Well, if anything, the low volatility you had both in the VIX and in the MOVE index a couple of weeks ago was more the surprising scenario where none of us really thought the outlook was going to be so smooth or so certain, but you saw MOVE and VIX quite low levels. They've come back up, which is probably healthy. I think we need to appreciate there are going to be some shocks. It's going to be the challenge then to take advantage of those, if you will, to find the opportunity in the volatility, which I think is almost certain to come given the politics, given the geopolitics, given the uncertainties about the economic outlook. It's part of how we try to invest, and that's going to be certainly impactful both for equities and fixed income markets.
Dan, we're going to have to leave it there. So great to kick off the new year with you. Thanks for joining us. Dan Morris of BNP Paribas Asset Management. Let's get you some other top stories now that are trending on the terminal. A person familiar tells us that leaders from the U.S. Dock Workers Union and employers are set to resume contract talks on Jan 7th as a threat of a strike looms. If a deal is not reached, a strike could occur when the temporary extension expires on January 15th, disrupting the country's container volumes.
To the UK, house prices there are climbing within touching distance of record highs at the end of 2024, suggesting the resilient property market gathered more momentum. It was the fourth consecutive monthly increase, and it chimes with other data showing solid buyer demand despite affordability challenges. House prices are expected to climb 4% in 2025.
Citi and Bank of America are becoming the latest lenders to leave the Net Zero Banking Alliance. That's a global climate group. Already Goldman Sachs and Wells Fargo have left. The exits come as financial institutions are getting pressure from Republicans to distance themselves from groups supporting carbon emission reductions.
Coming up, Nippon Steel makes a last-ditch effort to buy U.S. steel. More on the details of the offer. That's next on Bloomberg.
The top names at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me, but we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's your Bloomberg Brief on the first trading day of 2025. Danny Berger alongside Manus Cranny in New York. President Biden is entering his final days of his term, and with that, Nippon Steel has decided to act. The Washington Post reporting that the Japanese company has made a fresh offer in its bid to take over U.S. Steel. You can see there U.S. Steel jumping on the news, almost 10.5% on that, the most in a year. For more on that, let's bring in Bloomberg senior editor for U.S. economy and government, Derek Wallbank. Derek, what exactly is this new offer on the table?
Well, the new offer aims to deal straight with a CFIUS objection. Remember, CFIUS is that group in the U.S. government that reviews foreign transactions for national security things, and it advanced this sort of unique economic security argument. And so the Nippon Steel deal offer here is actually pretty straightforward. It basically says it would give the U.S. government a veto over any potential decreases in American steel production, U.S. Steel Corp production capacity, right, as a result of this transaction. And so it's a very straightforward attempt to deal with the CFIUS objections at face value. Now, there's sort of two ways that you can look at this. One of them is to say this is a Hail Mary attempting to deal with this on its face, but this may not have been about the face issues. This may be, more things going on, and this is sort of destined to go anyway. President Joe Biden has 15 days from the CFIUS review coming in to give a verdict on this. There's reports that he is disinclined to acquiesce. So that's one way. But the other way is to say, look, maybe there's some behind-the-scenes 3D chess going on here, and maybe this is a way that every party can save a certain amount of face and get the deal done. And certainly the market reaction a little bit split the difference, but did hew a little bit towards part two without fully pricing in part one.
Well, it's interesting, Derek, good morning to you, the way in which Nippon have attempted to counterbalance the argument. They've basically said, look, without this transaction, given the limited resources of U.S. Steel, it will revert to a pre-transaction strategy of deprioritizing existing union-represented facilities. So this is, carrot and verbal stick, isn't it?
Yeah, it really is, Menace. And again, sort of to the point that I was making here, I'll just sort of read from the pricing here, right? The shares are still trading. We're still trading at more than $20 less per share than the offer. So there's still a wide amount of market skepticism sort of priced in, right? But you are seeing a lot of these sort of, I don't want to say quite Hail Mary, but sort of last minute maneuvers. And sometimes you say the good bits, and sometimes you say the scary bits, and overall you hope that something comes out of it. Now, Donald Trump has said that he's not a fan of this deal, but it's not going to be his call necessarily, because this does come due during Biden's presidency. And look, we've seen this White House now in the last couple of weeks become a little bit less predictable, and so maybe there are some last minute options that are available to Nippon Steel as they go forward with this. that's certainly what they're hoping by putting forward an offer like this to try and deal, as I say, with the face value objections that have been raised in the review process.
Derek, is there not some risk, though, in an agreement that takes this form, that gives the government a veto power? Because, as you say, Trump will come in, and he is someone who has publicly said many times that he doesn't think this deal should go through.
Well, yes, Danny, and that's right. I mean, administrations change, don't they? And the times change with the administrations. Now, I have heard, and this is sort of to pull back a little bit, but I think it gets at a larger issue that you bring up. I have talked to a lot of diplomats in this part of the world, sitting in Singapore right now, who have said that they're trying to, amid the wild gyrations between administration and administration in the U.S., trying to find ways for their countries to pursue sort of administrative agnostic relations with the United States and sort of insulate there. So there is some hope that if some of these deals, whatever they may be, can get sort of nailed down and written down so that there are key triggers, then maybe you actually do get some of that administrative agnosticism. But you're quite right to highlight the idea that these administrations do change, and the one from Biden to Trump, just as from Trump to Biden and as from Obama to Trump before, you're going to see some very wild policy gyrations where certain things that were off the table for Biden are on with gas for Trump, and certain things that were on with gas for Biden are dead in the water under Trump. And that's going to be a key geopolitical risk thing we're going to be closely tracking, but I think all market participants are going to be tracking this year. This is going to be a key market theme throughout 2025 for sure.
Okay, Derek, well, let's see what comes through. The clock is ticking down, as you said, still trading at a discount to the original offer. Derek Woolbank there on the very latest on Nippon Steel's offer for U.S. Steel. Markets kicking off 2025 in the green, Danny, on S&P 500 up 0.5%. But that dollar had a blinding year last year, up 8%, the best year since 2015, and we're flat at the moment.
Yeah, and this Treasury market, again, it had somewhat of a bid to end the year, continues. We are lower on your yields by nearly 3 basis points, 4.54% minus.
Coming up, 2 deadly events over the holidays set off an FBI investigation into a possible link to terrorist groups. We give you the context on Bloomberg Brief.
You missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
From our world headquarters in New York, I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
It is Bloomberg Brief. I'm Menace Kenny alongside Danny Berger here in New York. Let's get you up to speed with your front pages on day one of trading in 2025.
Yep.
We have the journal kicking off with Russia has halted natural gas flows to Europe via Ukraine after Kyiv's refusal to extend a pipeline deal. Ukraine said it wouldn't extend the deal because it was providing revenues that helped Moscow conduct its war in Ukraine. Now, the end of the deal was long expected and will have limited impact on Europe's gas supplies.
Next up, the Washington Post has this, that Chinese hackers breached the Treasury Department's sanction office. That's according to officials there. The targeting reflects Beijing's determination to acquire intelligence. There have been a lot of Chinese-linked hacks as of late. The full impact of that breach, which was disclosed by the Treasury in a letter to Congress on Monday, that menace is still being assessed.
And on Bloomberg, the U.S. security is back in the spotlight after the deadly attack in New Orleans and an explosion of a Tesla Cybertruck outside President-elect Trump's hotel in Las Vegas. That was on New Year's Day. President Biden spoke about the two incidents at a press conference.
We're tracking the explosion of a Cybertruck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection to the attack in New Orleans. Thus far, there's nothing to report on that score at this time.
Now, here's what we know at this moment. In New Orleans, at least 15 people were killed. Dozens were injured. The suspect was killed at the scene, a U.S. Army vet, a U.S.-born citizen who was also flying an Islamic State flag on his truck. Posts on social media, Manus, also indicated that he was inspired by ISIS. Just to put a bow on this, law enforcement and intelligence officials have been warning for months that conflicts in the Middle East could mean that there are lone wolf attacks inspired by them, inspired by extremists, that could happen during the New Year's and Christmas celebrations.
And the FBI are investigating this as an act of terrorism in New Orleans. If we pivot to what actually happened in Las Vegas, it was a separate incident. A Tesla Cybertruck exploded in Las Vegas. This was in front of the Trump Hotel. Now, Elon Musk has said online that he suggests it could be linked. This is from Musk himself, not the officials, that it could be linked to the attack in New Orleans. Provides no evidence for that. The FBI, as I say, are investigating both, and we should say that in that incident, the driver has been killed and 7 others are injured. Musk has said it's a very large fireworks and a bomb carried out in a rented Cybertruck, and we know so far both these cars have been rented from one company.
Right, it's called Turo, and that's specifically what Musk pointed to say that they were linked. Again, officials at this moment do not believe there is any link, but they are investigating them at the time. You heard comments from Biden there, Trump posting this on Truth Social, saying our hearts are with all of the innocent victims and their loved ones, including the brave officers of the New Orleans Police Department. The Trump administration will fully support the city of New Orleans as they investigate and recover from this act of pure evil.
And it is that. He describes it as an act of pure evil, and the explosion in Las Vegas, according to him, was according to law enforcement, was intentional. We'll keep you abreast as we get more news flow in terms of the incident and what is going on with that.
Yeah, and coming up, we also are going to talk about the policy impact on markets. We'll catch up with Sonia Meskin of UBS on your brief.
Asia is a continent of contrast. The region is a nexus of rich cultural traditions and a vibrant hub of trailblazing innovation and modernity. How will it push the limits of technology even further?
Going to space should become as easy as, taking a flight.
If NASA is designing a lander, their approach is they're designing a Formula One car. So we take, say, a Jeep approach.
Minister, give us a sense of how you translate Korean architecture for the rest of the world.
We call this madang. In general terms, it's where we can be ourselves, where we belong.
There is an old saying in Korea that says, "Komi bulu, hwai 불치." It means simple but not humble. So it has a tremendous impact on Korean architecture.
People tend to think the robot AI taking the job from them. We want to use the robot as a basic asset, meaning people have an income through the robot.
From space tech in India to robotics in Japan, Asia is driving the future, reshaping industries, societies, and the way we live. Join me as I take you through the bold innovations. Discover Asia's next-gen technologies on Momentum.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manus Kriani. Let's set your agenda.
On security alert, the FBI investigates a potential link to terrorist groups after a deadly attack in New Orleans and a Tesla explosion. New Year's rebound, markets kick off the year with tech leading futures higher after a year-end slump. Nippon Steel ramps up its efforts to win the approval for its takeover of U.S. Steel. Good morning and Happy New Year, Danny. Welcome 2025.
And welcome to the first trading day of 2025. And you'd hope that this is the pace that we set for the year. The NASDAQ leading the gains, as you mentioned, Manus, up more than 0.7% after a clear risk-off move since Christmas. The S&P falling for 4 consecutive sessions. That's the first time since September. Maybe just locking in profits after a 25% plus total return for the S&P. Your 10-year yield, that is also seeing a bid. Yields falling this morning for the bond market. It is the 4th consecutive year, though, that you've had Treasury yields move higher, the first time since the 1980s. Again, a bid here. How long does it last? What does policy look like? Manus, there are so many questions, and I think anyone who enters this year with certainty maybe needs a hubris check, because we have gotten this wrong literally for the past 5 years.
Yeah, absolutely, but there's brave trading ranges in between. 23% up on that S&P 500 last year. Bonds lost 0.6%. Dan Morris, I mean, fully hedged are what? 4% on the downside, 5% on the upside. And then you read the front of the FT this morning. Maganomics will deliver stagflation. And I think that's an interesting survey of the world, of the pool, of that echelon of society that lives in the finance bubble.
Well, it's an uncomfortable place to be, and I think Daniel Morris of BNP really underscored this idea that Treasury markets are going to be really volatile. So the sure thing is U.S. equities. But how sure of a thing are they when valuations are incredibly rich, when we're still being driven by tech? You say U.S. equities do the best, but again, how comfortable can you feel sitting in that risk asset?
It's whether that exceptionalism endures and whether you actually do get, you could actually get a bit of a shock from Europe, a bit of a shock from China in terms of stimulus. I love what Peter Cheer said at Academy. Messy is manageable. Chaos is not. Negative on rates, negative on equities, and therefore on credit for the start of the year. I like that. Messy is manageable. I like that most mornings at around 2:20 when the alarm goes off.
Sometimes we are quite messy at that time, but manageable. Will the new
Absolutely, every day.
Will 2025 be the same? We are just a couple weeks from a new administration stepping in to the White House. Sonia Meskin of UBS looks ahead to the market impact, writing this. We expect new administration policy risks impacting 2026 more than 2025 in real terms, but headline risk remains high in 2025, and we can see economic agents altering their behavior based on policy concerns. Sonia, I'm pleased to say, joins us now. Sonia, great to see you. Thanks for spending your first day in the new year with us. First day of the trading day, I should say. It is January 2nd. But I love this idea because at the moment, we don't get to see what's in the policy box really until this year, and we don't see the effect of it until 2026. So just taking a peek in and having that imagination run wild, what can it actually do? What impact can it actually have to this economy?
Well, for 2025 specifically, what we're looking at is any kind of change, as you guys just mentioned, from various economic agents. Are businesses altering their mix of imports, for example, right? Are consumers altering what they're potentially going to buy as a result of anticipating tax changes or as a result of anticipating, higher prices, for example, from tariffs, right? We're not seeing any of that yet. We would first expect this to see on the business side, but it's not showing up on the business side as far as we can see yet. People are talking about it, but they're not yet putting their money where their mouths are.
One thing we saw just before we went home that sort of slid under the radar was the Purchasing Managers Index in Chicago dipped. The leading economic indicators also turned negative. There are, I would say, cracks, not fissures, and not implosions. So how do you look at economy 2025? Does the U.S. still diverge, strongly from the rest of the world, given the status quo, even just at status quo?
Well, we have a lot of moving parts here, right? And so even if the U.S. does continue to slow, the divergence could still persist because there are many difficulties also facing other major economies, namely China and Europe, right? And the housing market in China, for example, and the consumer in China continue to be relatively weak. Similarly, the whole transformation to electric cars in China is impacting the car industry. In Germany, for example, we still have high energy prices hurting Europe. So the U.S. is immune to some extent from a lot of the impact of those policies. Not fully, but to some extent. And we also have a very strong consumer. We have a huge wealth buildup.
It is interesting because the frame has been U.S. exceptionalism. Everything you're saying makes complete sense in that light, but driven by policy, driven in tax changes. I was looking at some of the sentiment surveys just to end the week. There's one from the ISM that their forecast is that the increase in manufacturing capex will be less in 2025. The National Association of Manufacturers says that their expectation is a 1.6% growth over the next 12 months of capex, which is kind of weak if you're expecting all these tax cuts, and a lot of people pointing to just the unknowingness of tariffs. If we don't know what's going to happen, how much in that self is a reason to pull back, is a reason for the economy to slow down rather than the expectation of tax cuts for corporations?
Absolutely, and that's part of the risk, I think, heading out of 2024 into 2025 that we've highlighted multiple times, is that, yes, deregulation can be helpful to the markets, but the uncertainty from tariffs, and there's going to be a lot of headlines coming out on this. There's going to be probably a lot of negotiation in the background going on. The uncertainty itself impacts business investment.
And this is the front page of the FT this morning, Maganomics. They've done a survey, and it is that short-term juice, let's say, from the tax, but the downside is for global growth, and that delivers ultimately stagflation. Is stagflation a 2020, to your point, Danny, is stagflation a 2026 issue, not a 2025 issue?
Well, even stagflation alone is a term that we need to unpack a little bit, I would say, because do we see from the tariffs, if the tariffs are in fact put in place, and there is broader tariffs, and there is potentially retaliation from trading partners, does this all lead to a one-off rise in prices or in increasing in prices over periods of time, which really would be stagflationary?
You write a little bit about this treasury market and sort of the balance of demand, and especially as we get new issuances throughout this year. Deficits were supposed to be this thing that were really concerning for the market, and I feel like to end the year, you saw a little bit of that run up in yields heading into the election, and it kind of faded. I mean, how concerned are you about the viability of auctions for the deficit, for the demand and the supply to still be absorbed by this market?
We still have, there must be compositional changes, and there have been over the years compositional changes in terms of the marginal buyer for the treasuries, but we still have very, very healthy demand, obviously, for U.S. treasuries. So our view fundamentally is that demand for treasuries is going to be driven by the business cycle.
You actually doubt one of the doubts that you raise, or one of the flags that you raise, is about the regulatory reforms, and this is the Besant reforms, the threes: 3% deficit, 3% growth, and 3% growth in energy, oil and gas. Put it together whatever way you want. We need to understand. But you don't think that regulatory reforms will generate enough demand for treasuries and for duration to neutralize the looming supply. So you have your doubts around this deregulation story.
Well, deregulation matters. It also matters for banks, for example, right? So there are specific sectors like energy and banks for which deregulation may matter more than for others. Right. But the Treasury is such a huge liquid market that really fundamentally what we believe is that if the business cycle does well, then demand will wane and go more into risk assets. And if the business cycle slows, then there's no way around Treasury demand.
Well, there a lot of what regulations we have seen have meant that banks are trading treasuries less, that some of the demand and the way that things have been reconfigured is because of that. Then you have central banks abroad who are buying less treasuries and buying more gold. Or we just need to get used to a new normal where it's price-sensitive buyers that are really active in this treasury market?
Yes, and we have had price-sensitive buyers become more active in the treasury market, but as their participation grows, they also become more stable investors in the market.
Do you think we get moments of indigestion in this bond market rather than Liz Truss-like incidents?
Tough question. Could go either way, I would say.
I think there's going to be volatility. I think the bottom line is probably there will be moments of sort of unexpected volatility in global bond markets, not just the US. Sonia, thank you so much for being with us. That's Sonia Meskin of UBS, our guest this morning, setting the agenda on the markets. Coming up, port talks, port employers and dock workers come back to the negotiating table. More on the story next on Bloomberg.
Are on Bloomberg.
The question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are, and that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. We got to realize that the impact we have if we don't get this debt back in line.
Nobody covers business like Bloomberg. Context changes everything.
You talked about how governments are not looking at healthcare and investing in healthcare as much as they should. What's the message you'd like to send to those governments?
Well, I think a healthier population is always going to be more productive. It's just that sometimes the political will isn't there in some of these countries. So I hope that they can keep this as a priority, because a workforce that is 20 or 30% down during a pandemic or an outbreak, or there's certain diseases that keep spreading, is not healthy, it's not productive. And if you want everyone to perform at their best, and you want healthcare costs to be down, you don't want to be burdened with insurance costs and other costs, I think it's important to invest early in health, in child health, in women's health, and I hope that continues both in India and other parts.
Wants to use your product, Zepbound, how much does it cost a month?
You can buy Zepbound direct from Lilly for $3.99 for the starter dose.
$3.99?
No. This is a valuable innovation, David.
It's Bloomberg Brief. I'm Menace Cranny, back alongside Danny Berger for 2025. Story for you now. Bloomberg sources say that talks are set to restart between dock workers and port employers in the US next week. This comes as a potential of another mass walkout looms over half of America's cargo. For more, let's get to Brendan Murray, who leads our coverage on global trade. Brendan, good to have you with us. I mean, this takes us back to, we thought we had a deal between the International Longshores Association and the United States Maritime Alliance, which was a 62% pay rise, but it looks as if the sticking issue is automation.
Yeah, exactly. They left that issue on the table back in November when they agreed to talks. Those talks lasted only a couple of days, and we've been in this 6 to 7 week stalemate until recently, until the past day or two, when we've heard that they're going to restart those talks starting next Tuesday. So they'll have about 7 or 8 days to iron out those issues before the January 15th deadline. After that, if they don't extend the negotiations, we could see the dock workers walk off the job.
And if that happens, 5 days later, it's a new administration. Trump takes the oath of office. And we had a moment, Brendan, where Trump has said that he, one, supported the dock workers and the union, but two, also supported autonomy, and that it's the way that the world was moving. Where will Trump stand? What do negotiations look like when you have a labor secretary that is now under the Trump administration?
Yeah, there's real tension here between what the union wants, and that's preservation of their jobs, and what the incoming president wants, and that's an economy that's more efficient, better operated, and those kinds of things. That's the argument that the port operators are saying is we need semi-automated equipment to make sure that the increasing amount of goods that move in and out of the country do so efficiently, and in the meantime, the dock workers are saying, no, that's a threat to our livelihood. So you have a real, sort of tug of war here between, the old way of doing things at ports and the future of how to move cargo at ports.
Well, I think just before Christmas, he said, this is President-elect, I've studied automation, I know everything there is to know about it, and the amount of money saved is nowhere near the distress, the hurt, and the harm that it causes for the American workers. Brendan, I mean, there's essentially what Trump said before Christmas. So let's see where he comes in on this over the next couple of weeks. Brendan, we've heard from AP Muller-Maersk. They've pushed people to move and shift their shipments across the east coast of the United States of America. Is that getting ahead of the issue? What does that do to the flow of trade into and out of the eastern seaboard?
Well, what we saw Maersk say in the past day or two was urging customers to get their containers out of ports, whether those are full or empty. You don't want them sitting there, for weeks on end if a strike happens, and it drags on for longer than people expect. At the moment, the expectations are that this, even if it is a strike, will be relatively short in duration. The economic damage will compound relatively quickly, and so both sides will have an incentive to reach a deal.
Brendan, we really appreciate the update. That is Bloomberg's Brendan Murray. Now, futures kicking off the year with a rebound after a 4-day decline. We are keeping our eye on a variety of stocks in 2025. Bloomberg Intelligence has compiled the list of 50 companies to watch this year. Tim Craighead, Director of Equity Research at Bloomberg Intelligence, joins us now. Tim, give us a little taste. What is company number one that you're looking out for?
Oh, that's impossible to say one company, Danny.
It's like picking your favorite child.
Give you some context. Exactly. Give you some context. I mean, this is a list of 50 companies that fall out of our broader list of focus ideas. You can find it on the terminal, BI Focus. But these are high conviction, fundamental calls that we think are different from where the market lives. And there's catalyst ahead in 2025 to bring focus into our view on these 50. And I think you could maybe answer your question. There's key buckets that I think fall through the list. Think AI, think China stimulus, think innovation and new products. So I think some of those key companies fall into those topics and themes.
Tim, good to see you this morning. The great debate is on AI and whether the Mag 7, the valuations, the earnings, will the earnings live up to the valuations and vice versa? Does the AI, and we've heard this from several houses, does the AI theme broaden beyond the US shores in size and significance?
So I think you can think about broadening in a couple of ways. Number one, the names that we have that are AI-oriented on this list are more enabling technologies, where last year we had some of the LLMs and things like that. So think about Micron technology because of high bandwidth memory chips, or KLA, which makes test and measurement tools that are quite critical, or here in Europe, thinking about broadening out geographically, VAT group that makes valves, and you think, what? But these valves are quite critical to create vacuums, which are critical in semiconductor manufacturing. So I think you can see it broadening out to enabling technologies and then applications of AI as opposed to just LLMs and NVIDIA.
Tim, how much of this could just get upset with any new policies coming in from the Trump administration, be it corporate tax reductions, but with some caveats to that, or be it tariffs? How much could this completely throw everything into disarray for what we're looking at for 2025?
It's a great question, Danny. I guess from our perspective, there aren't Trump plays per se here. And, you know, our economists are thinking the tariffs are more a 2026 issue. It's a negotiating tact this year. But what can come quickly are things like regulatory changes and taxes, and those are both positives. And from that perspective, it plays into more of a cyclical recovery story. We still expect lower interest rates, and from that vantage point, you can see a host of companies that are oriented in that way. Adecco is employment-oriented, Airbus with traffic and improving supply chains. Rémy Cointreau is a consumer product company, you know, a spirit maker. Those are some of the European plays, but then you've got companies like Norfolk Southern and Emerson and others that are on the list that are just good cyclical plays with a president that's in place that we think will lower taxes and will deregulate in various ways.
Tim, let's see what those first 100 days come through with in terms of edicts, orders, and policy. Tim Craighead of Bloomberg Intelligence setting the agenda. 50 top companies for you to keep an eye on. You can pick it up on your Bloomberg terminal. BI Focus Go is the destination. Let's pivot to China there. Tim was mentioning some of the potential risks in 2025. Stocks there have posted their worst start to the year in nearly a decade. Let's get to Bloomberg Markets reporter Justina Lee. Justina, good morning, good afternoon. Good to see you this morning. We're kicking off with a pretty bearish start, the worst since 2016. Now, in part, this is to do with the manufacturing data. Let's kick it off there. Caixin, along with deflation, it's the key word that we're kicking off 2025 with.
Yeah, I mean, the Chinese economy got some pretty bad news, you know, at the start of this year already. What's happened is that, you know, the Caixin PMI, it's kind of fell again, and it's still within the expansion territory, but it was lower than what a lot of economists expected, and it was also lower than the November reading. And I think that's just generally adding to the gloomy atmosphere. A lot of traders and investors are already worried about the prospects of, obviously, U.S. tariffs on Chinese goods. And these numbers kind of just underscore how tough the environment is already.
But we just came off the back of the Central Economic Work Conference in December, where more spending, more public borrowing was promised, and it was something that had excited investors, but maybe not enough to filter through to equity market sentiment. What now, Justina? When do we see any potential follow-through, any more announcements that you could get some real juice out of?
Yeah, Chinese policymakers have been pretty clear that this year they want to step up fiscal spending. They want to shift the focus to consumption to kind of insulate the economy a little bit from kind of those U.S. tariffs. But I think, you know, what people are watching right now is when is the next monetary policy move? And we've already seen kind of a big liquidity injection recently. So maybe there wouldn't be like a headline, you know, rate cut coming that soon. And I think, you know, for the Chinese government, it's a bit of a balancing act right now, because because with the dollar strength, they're also worried about kind of the weakness of the Chinese currency. And we're also seeing that today because they strengthened the fixing to try to stabilize the currency kind of despite the trends in the currency market. So I think where the yuan is going is another thing to watch.
Okay, Justina, appreciate it. Bloomberg's Justina Lee there. Coming up, we're going to set you up for your trading day. Some economic data on deck for January 2nd, your first trading day of the year. Stay with us. This is your Bloomberg Brief.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back. Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Let's set you up for your trading day on this Thursday. The new year is going to kick off with jobless claims numbers. Those come out at 8:30 a.m. Eastern. Then it will be followed by U.S. manufacturing PMIs, 9:45 a.m. And then, Manish, we're going to get Tesla releasing its fourth quarter delivery data.
Yep, and that fourth quarter, is it going to come in over that 500,000 mark? That's going to be the critically important thing about delivering on Elon Musk's promise for growth. The stock is up 1.2% this morning. You've had a nice turnaround on Bitcoin. That plays, of course, into MicroStrategy. Crypto-linked stocks, they're all rallying this morning as we see Bitcoin up for the third day in a row. U.S. Steel, we've talked about this morning, up 0.6%, jumping the most in a year. In the previous session, again, will Nippon's Hail Mary deal, as our correspondent called it, make it through and over the line with Joe Biden? What are the caveats? What might he do with that final offer that's been slipped across the table? Danny.
Manis, a quick check on your euro this morning. It is weakening versus the dollar by about 1/3%. The euro is now at its weakest level since November of 2022. This is an enduring theme for 2024 and heading into this year, where policy looks not completely diverged, but a Fed that maybe looks something something like on pause, and a Europe that's forced to cut, especially with Trump tariffs?
I mean, just going back to 2016, just looking at the data, that trading into 2017 came under immense pressure, but the dollar was so strong last year, up 8% overall, the best year since 2015.
Yeah, and look, the bar is very low for Europe, so maybe we could get a surprise. Well, that's it for your brief surveillance. We'll take it from here.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Bull cases have gone away.
There's quite a lot of momentum still to be had, particularly in the first half of next year.
What tends to happen, though, in January is all the sort of market moves that we have in December get completely unwound.
As the market broadens out, what that means is that the former winners are going to start to decline a bit.
I'm not really sure if markets really know what to expect. I think that creates some volatility.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into 2025, following the best back-to-back yearly gains since the late 1990s. Equity futures on the S&P 500 bouncing back from 4 days of losses. On the S&P, we're higher by 0.6%. On the Nasdaq 100, we're up by 0.8%. Your forecasts for 2025 shaping up as follows. They look a little something like this. The average, about 6,600. The highest, Oppenheimer's John Stolfus at 7,100. The low, Lisa, the low, and Happy New Year, comes from Cantor's Eric Johnston at 6,000.
Yeah, well, again, this isn't exactly a terrible year of losses after the 2 consecutive biggest gains in the S&P 500 going back to the late 1990s. A real question here about where the leadership will come from, because what we have seen is a narrowing in breadth. This past year was supposed to be the year when big tech lost its dominance to the rest of the equal weight. That has not happened. So that's the question. Can big tech continue to power the rally that we've seen so far?
Post-election, we all heard the calls. We were going to see increased participation, negative breadth. We were going to see small caps pick up the mantle. We saw that for about a month through November. Then in December, they had a terrible month. Let's see what January brings. As for January, this is the lineup. So January 10th, we get payrolls. You've got to wait another week for that. That's next Friday. The week after that, you get CPI on January 15th. And then we've got the inauguration on January 20th before we get the Federal Reserve on January 29th. So, Lisa, the year doesn't really begin until we get that data on the 10th and 15th. And then for many people, the year still won't begin until Inauguration Day in America.
So essentially, we can get all of the revisions to those forecasts starting in March. As you always say, start writing your year-ahead forecast in March at a time where there are a lot of questions about the tale of two halves. And that's what we hear in pretty much every outlook that we hear for equities, for bonds. The fact that the first half of the year will be this question of what the Trump administration can do. The back half will be what the ramifications are for some of those plans as they go into effect. That's the reason why it seems like there's more confidence baked in about the first half than the second half about dollar dominance, about the idea of potentially some of these ongoing gains.
Jim Reed of Deutsche Bank attempting to make it easy. He writes the following this morning. For the last 4 years, the first trading day has been a contrarian indicator, with the S&P 500 ending the year in the opposite direction it moved on the first day.
Basically, ignore it all, go home, stay on vacation. Look, I think that there's a really big existential question right now for markets. You've had this massive rise in 10-year yields that has really pressured a lot of that equal weight, that has really created this existential question. Is it that rates are too expensive or too cheap, rather, or is it that stocks are too expensive? And that ultimately is going to be the question, and it's not going to be established today on January 2nd when everybody comes back to work, before we get the payrolls, before we get CPI, and before we get a real sense of what a Donald Trump administration will look like.
70 basis point move on the 10-year yield through last year. 70 basis points. The 10-year this morning, 453. HSBC's Max Kettner says we're in the danger zone. And that means it's going to be a choppy ride for the first month of 2025. Got to get used to saying 2025. Welcome to 2025 and Happy New Year to you all. Equity futures on the S&P to kick off a brand new year, elevated by 0.6%. Coming up this hour, we'll catch up with Jeff Yu of BNY, looking for a continuation of trends in 2025. James Lucia of Capital Alpha Partners ahead of a House Speaker vote. And we'll speak to Dan Ives of Wedbush on his top 10 tech winners for this year. We begin this hour with stocks rising to kick off 25. The S&P 500 closing out its best two-year run since 1998, despite ending 24 with 4 days of losses. Jeff Yu of BNY writing the setup for markets into this year is good for a continuation of trends. There's uncertainty ahead, with all the plans and forecasts for 2025 expected to change on January 20th when President-elect Trump starts his term. Jeff joins us now for more. Jeff, welcome to the program, sir, and Happy New Year. What have you told clients about how to approach the beginning of this year, when for many the year does not begin until the inauguration on the 20th?
Well, certainly we would agree with the dates in question. But when we go back to the points about continuation of trends, on the U.S. side, we've said last year, if it ain't broke, don't fix it. U.S. exceptionalism is something that we do believe in. And I think it will manifest itself through growth, through rate differentials. That's being priced in already via the dollar. But I would say for APAC and also for Europe, I think where there may be a slight trend change, it's not suddenly everything getting better, but maybe less bad. And when you have that less bad narrative coming in, some of the other trends which have been maintained, I'm still targeting euro-dollar towards parity, for example, but how much further can we actually go through that? Are people talking about further downside in Chinese equities, for example, when there's such a strength of them feeling domestically surrounding the need for growth to stabilize or even improve, as the leadership has highlighted? So that less bad narrative elsewhere outside of the US, I think that could provide for some surprises up ahead.
Saw that downside side in Chinese stocks earlier on today, Jeff. The CSI 300 down by close to 3%. The Hang Seng in Hong Kong finishing the session lower by more than 2%. It's actually the fragility stateside I wanted to build on. 4 days of losses in a holiday period. I get all of that. But we saw that weakness emerge through much of December. The negative breadth that Lisa was talking about. The underperformance that we saw in the small caps, the Russell, after a monster gain for the month of November. How much weight are you putting on some of the weakness that we saw to finish 24 into 25?
Well, I would back you up by saying if I look at our flow indicators, especially on the volume side and in FX in particular, it actually has dropped off quite a bit in Q4. Not really something that we want to see. But look at the event risk in Q4. We had the US election, we had the December Fed, but this didn't really force through a rise in activity. So it just feels like people are happy with their positioning. It's not that they're negative. It's just how much follow through, how much incremental positioning can you allocate to what you have already done already? I think that's something we have to be concerned about in terms of what's driving markets. Do people want to be more overweight their current positions compared to where they were? I think that's where the nervousness is coming through, and maybe relative value trades for the time being, especially for Q1, that's where people will deploy risk.
I could buy that, Jeff, this idea of exhaustion, the idea that people have had a really good year and they don't know how much more risk they want to put on. At the same time, that weakness that we saw at the end of the year really came with a rise in yields. That was raising this question of why. Was it really just that the Fed had a more hawkish tone? Was it something about the data outperforming that we'd already seen pretty consistently? If anything, the surprise index has fallen off, not increased. Why did we see such an increase in real yields, which, as Max Kettner of HSBC says, is reaching the danger zone?
Well, real yields, we go back to 2022 and 2023. I think if we take a step back, what do yields reflect? They reflect fear over inflation. So if there is a inflation surprise to the upside in the US, then real yields will need to be higher. And then as a result, financial conditions will need to be tighter. And in the US in particular, how does that manifest itself? Lower equities as well. We look at credit spreads, we look at outright yield levels, and we look at equities. FX plays a far smaller role in the US. So equities, that seems to be the last shoe to drop in terms of a tightening in financial conditions that's needed. So it all goes back to US policy at the end. Where does fiscal lie and where does the tariff situation lie? Because these two factors contribute directly to the inflation outlook up ahead. If the household is going to look at everything and say inflation is going to rise and they're going to be much more cautious and corporates respond accordingly, I think that's where the caution is going to be needed on the equity performance front as well. But again, let's cross that bridge when we get there. We haven't seen the policies yet.
Right, which is the reason why there's sort of this question, does it even matter? Do we need to come in until January 20th until we get some sort of inauguration and then a set of policies from Donald Trump? At what point can you sort of say whether you either have rates that are too cheap or stocks that are too expensive? Can you weigh in on that, or do you just basically tread water until that inauguration?
I think it's going to be quite cautious heading into inauguration. Activity levels I would expect to be low. It's not taking off risk per se, but going to what we've seen, there may be a lack of interest in putting on risk. Once we get past inauguration, when we get into Q1, by the way, if I look at Fed pricing right now, so markets are not really looking for a full cut until after Q1, maybe closer to mid-year, something along those lines of the June meeting. So in that context, it's just a holding pattern for the first 6 months. And again, that's where the inflation expectations are going to build. So I'll be looking at the earnings season heading into Q1, what the guidance from corporates as well, what are they seeing from the ground? What are their contacts in Congress telling them about policy up ahead, how it's going to impact them and how the Fed's going to react? So I think that's where we're going to get the bulk of the changes. But for the next 2 or 3 weeks or so, certainly a holding pattern.
Well, Jeff, let's build on your understanding of what the policy priorities actually are in Washington, D.C., because many Republicans spent the holiday season arguing over H-1B visas. What's your understanding of what the priorities might be?
So in the labour market context, I think that's where it matters for inflation, for wage growth. Look at the trouble that every single central bank has had with over the last year, over the last 2 years, really, labour supply. So this may be a smaller component of that, but the policies need to be done in a way which boost real income growth rather than nominal income growth, because if it's just nominal income growth, but then the inflation builds on top of that, people don't actually feel richer, and I think that's going to hurt sentiment as well. So if we have the right policy mix which guarantees productivity gains, again, this really anchors our thesis of US exceptionalism. Its productivity growth, potential productivity growth is so much stronger than elsewhere. Let that guide real income growth in the US, and if there are lessons to be learned, I hope the rest of the world, especially in Europe, can actually try to emulate the US. But getting that productivity side wrong means you get real income growth wrong, and that's where you can get an inflation spiral again, but that's not our base case.
Jeff, some people believe that by the middle of December last year, the Federal Reserve was already starting to incorporate some of the policy changes from the incoming administration. Did you agree with that particular view? And where does that leave them at the end of this month when they meet again?
So I don't think they are incorporating things, so they wouldn't be flying blind in that sense. If they had a sense of, okay, 50% tariffs or 20% tariffs or whatever number you assign to that, then on a numerical basis, you can actually feed that back into your inflation models and act accordingly. Sure, maybe some preemptive action or some guidance is needed, but you can do that in terms of communication. What I think a lot of central banks are incorporating right now, if I look at the Riksbank comments, for example, from a few hours ago, they are looking for stabilization and expectations. So somewhat astonishingly, Europe is actually sounding a bit more positive right now, even though they could be on the wrong end of tariffs as well. So in that context, the growth risk and thereby the inflation risk potentially is still to the upside for this year. We can get a China fiscal boost as well. So I think that's what the Fed and global central banks need to be attuned to. Growth risk, maybe they are worried about, but inflation risk, certainly they need to look at to the upside, and that's what the bond market is telling you.
Jeff, a lot of people are looking at this and saying that a lot of the bad news has been baked in, and then we get the news overnight about Ukraine shutting off supplies of Russian gas to Europe. This was expected. It's not necessarily something that they're not prepared for, but it does increase natural gas prices on the margins, and it raises the question of greater degree of inflation. How confident are you that the ECB is able to both sort of thread this needle of fighting what you see as the potential for upside inflation while also supporting an economy that, yeah, maybe a lot of news has been baked in that's bad, but still, it doesn't look very good.
Yeah, well, to be frank, the pivot opportunity was last year, when they could have escalated or strengthened their easing. So if they didn't do that last year, where the PMIs were, given how things seem to be stabilizing, that less bad narrative, we're going to get a new German government coming through potentially. France seems to have stabilized them for now. So if that investment narrative from the Draghi report come through, I don't think the ECB is going to change its language too much, to be frank. So given my euro-dollar view right now, it's more actually the Fed pulling back from its rate cuts and view at various points last year. I think that's what's driving things right now. But at the same time, I look at our flow data, I look at our positioning data. Euro positioning to the short is very, very extreme right now. So if we go through parity, have a look at fundamentals, valuation, assuming no geopolitical shocks, probably take the win, and then just look into stabilization from there, and then see how growth performs. But still, on a net basis, I still think US outperforms Europe for the time being. It's just a question of how Europe turns things around. I'll put the UK in that element as well. I think that's where the market is actually underpricing cuts. So I think that's where the central bank surprise could be relative to current expectations.
Interesting. One thing for sure, Jeff, we're set up for a fascinating year ahead. Jeff Yu of BNY. I think we should round it down. We're at parity right now. Euro-dollar 103. 103.32, lows we haven't seen on the single currency going back to November 22.
Yeah, I was looking at the dollar index and just how much it's outperformed, and I think that Jeff really summarized it perfectly. So far, it has been a story of European underperformance. Now does it shift to all the bad news being baked in, and now maybe the Fed not cutting nearly as much as people think because of this American exceptionalism. You can't have your cake and eat it too, with respect to rate cuts, ongoing American exceptionalism, and potentially an economy that keeps delivering these types of stock gains.
A lot of banks did a lot of surveys to close out the year. We picked out one. I'm going to repeat it. It came from Deutsche Bank. Only 2% believe US growth will be below 1% in 2025. Only 2% of respondents believe US growth will be below 1% in 2025. That's the average expected in Europe. That gives you an idea, just a decent sense of where expectations are for US versus Europe coming into a new year.
Which is the reason why less bad was the emphasis of Jeff. At a certain point, how much bad news has been baked in to Europe, how much good news has been baked into the US, and it goes to the point you were saying, which is the policy mix. Do we get a sense of truly more fiscal expansion in addition to tax cuts that don't have to be paid from anywhere? Because a lot of people are saying that's not realistic, and yeah, that is what's getting priced into a lot of American exceptionalism.
Kit Juice of SocGen coming up a little bit later. Look out for that conversation. The euro at 103.31. With an update on stories elsewhere this morning with your Bloomberg Brief. Chief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. A deadly attack in New Orleans, French Quarter, very early on New Year's Day, killed at least 15 people and injured dozens. The suspect, an American Army veteran, was killed at the scene. The FBI is investigating the attack, which involved a pickup truck and improvised explosive devices. The FBI is also looking into potential connections to terrorist groups and whether the suspect acted alone. The attack happened hours before the Sugar Bowl was set to kick off at the Caesars Superdome in New Orleans. The game was postponed until this afternoon. Meanwhile, Elon Musk says the explosion of a Tesla Cybertruck outside the Trump Las Vegas hotel was probably an act of terrorism. The driver was killed and 7 people suffered minor injuries. In a series of posts on X, the Tesla CEO says the explosion was caused by fireworks or a bomb carried in the rented Cybertruck and was not related to the vehicle itself. President Biden says officials are investigating whether there's any possible connection to the attack in New Orleans. President-elect Donald Trump says that he will lobby House Republicans, if necessary, to help re-elect Mike Johnson as Speaker. Trump endorsed Johnson on Monday ahead of a House vote scheduled for tomorrow. Johnson faces criticism within the party after backing a temporary spending deal that left out some Trump demands. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the House Speakership on the line.
I think they'll support Speaker Johnson. Almost everybody likes him. Others are very good too, but they have 30 or 40 people that don't like him, so that's pretty tough.
That conversation up next, live from New York City this morning. Good morning.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Let's get back to work, shall we? Equity futures on the S&P 500 up by...
I'm so excited.
0.6%. I say that reluctantly. We're up on the S&P by 0.6%, following gains of more than 20% last year and the year before. It's been a stellar run. In the bond market, yields are lower by 3 basis points on a 10-year. On the session, we're down to 453.28. Under surveillance this morning, the House Speakership on the line.
I think they'll support Speaker Johnson. I think we're going to have a great time in Washington, and I think we're going to get great support. That he's the one that can win right now. People like him. Almost everybody likes him. Others are very good too, but they have 30 or 40 people that don't like him, so that's pretty tough.
So here's the latest this morning. Congress kicking off 25 with uncertainty surrounding the Speaker of the House, Donald Trump, throwing his support behind Mike Johnson with a vote set for tomorrow. James Lucia of Capital Alpha Partners writing, don't worry about Mike Johnson getting re-elected as Speaker on Friday. There is no alternative, and he will be re-elected. How about a New Year's resolution for Congress? get rid of the debt limit. James joins us now for more. James, welcome to the program, sir. We've got a lot to talk about, including national security across several dimensions that Lisa wants to jump in on in just a moment. Let's lead where you started, though. The issue around the debt and the amount of appetite this incoming administration has to add even more debt to the national debt pile. How much appetite do you think there is?
Well, John, first of all, Happy New Year to you and Lisa. I think that most investors have been expecting Congress to pile on with giant tax cuts, unpaid for, and maybe even giant across-the-board tariffs. But what this exercise of the past few weeks show is that the ability of House Republicans in particular to execute on giant tax cuts is very, very questionable. Now, they will elect a speaker, but the fact that we've got so much drama involved in a simple setup thing like electing a speaker shows that the ability to pass large tax cuts is limited precisely because the same people opposing Mike Johnson are also people who profess at least to be against large amounts of new debt.
So, James, where do you think the policy priorities actually are?
Well, I think the policy priorities to start with are immigration, perhaps the first reconciliation bill to deal with the border and perhaps defense issues, but ultimately it is about the economics. And I do think it is about the tax cuts, both to stimulate the economy and also to redirect resources from the energy transition economy back into what we might call the old economy. I do think that we'll see tax cuts, but probably something on the order of $2 to $3 trillion that aren't paid for. And I think we'll see a real effort to add some pay-fors in there by deep spending cuts, by impoundments, meaning rescissions and deferrals of past spending, and a lot of creative efforts to find ways to offset the tax cut, to offset the cost of the tax cuts that they will probably pass. But those tax cuts probably won't come until June or July at this rate, too.
Which raises this question of how much we're baking in terms of hopes and dreams and how much that stands to be disappointed until then. I want to shift focus a little bit just because overnight we had that attack in New Orleans. We also questioning what the attack and the potential connection with the Las Vegas explosion in the Tesla car, what it might have to do with that. I'm just wondering from your perspective, are you concerned about an absence of leadership at a time where it's quite clear that the United States is coming under attacks on multiple fronts, whether it's the physical ones and the old school ones that we're seeing in New Orleans, in Las Vegas, or whether it's some of the high-tech probes that we've seen, the leaks, the breaches from the Treasury Department on a cybersecurity level?
Well, this is an extraordinarily dangerous time. And if you've been reading the coverage in the major newspapers now, the Wall Street Journal especially, but also the Washington Post and the New York Times, there has been a real lack of response from the White House, a lack of ability from the White House to respond that may in fact be linked with President Biden's declining cognitive powers, or so it's suggested. So anytime you have a transition from one administration to another, you see probing attacks. You see new potential adversaries trying to see where the new president is coming for. So, it's a question of these attacks. It's the Treasury Department attack. How exactly will things start to unfold in Ukraine? What will happen in Gaza when Trump takes office? We tend to think of the pomp and circumstance surrounding the U.S. Marine Corps band playing Hail to the Chief. It all seems wonderful, but in fact, our adversaries are testing the White House to see what its responses are, and every president tends to be tested early in his administration, if not immediately before he takes office.
Of all the national security threats that we've been seeing over the past couple of days, let alone weeks and months, which concerns you the most? Which do you have your eye on?
Right now, we're watching Russia and Ukraine more than anything else, just because that will be topic A. What other activities could Russia undertake as part of its hybrid war campaign to try to strengthen its position, to try to force Ukraine into submission? So we'll look at that. Obviously, the Middle East and Iran is another source of great agitation. North Korea, too. So it's the usual suspects, but I would probably put the emphasis more on Russia than any of the others.
James, appreciate your time. No doubt we'll catch up again soon. And Happy New Year, sir. Forgot that bit at the start. James Lucy there of Capital Alpha Partners. James, appreciate your time. I think we're all used to this awkward period post-election from early November to January 20th. This one is somewhat unique, though, in that we have people openly questioning the cognitive ability of the sitting president. We heard that from James just moments ago.
There's a question about how present he is. There have been a number of reports and a number of major media outlets about sort of how much he's retreated and how much some of his aides are trying to get President Biden to the fore. A question here about what kind of vulnerability is there in the United States in this period? What kind of security is there going to be on inauguration? Whether some of these attacks were targeted at President-elect Trump, whether this is something else. A lot of questions. I mean, honestly, it was a reason why over the weekend I was really searching for any details. How do we put this into perspective? Right now, market's not responding, but this real question of what this means for the next 20 days.
I'm pleased you brought up the national security issues across several dimensions. Of course, the tragic attacks of New Year's Day is something we'll cover throughout this morning on Bloomberg TV, but also these cyber attacks allegedly coming from the Chinese on the US Treasury Department as well. There are multiple dimensions to consider here as we all have to think about national security in the United States.
And it really focuses the efforts on the efficacy of government agencies, as a lot of people have a lot of doubts about, and frankly goes to the heart of some of the promise of President-elect Trump.
Up next on the program, we'll shift to tech. Dan Ives of Wedbush on what he sees as the top 10 tech winners for the AI revolution. That conversation just around the corner.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Let's check out the equity market bouncing back from 4 days of losses. On the S&P, we're higher by 0.6%. A lot of people are going to talk about the big yearly return, and we should. It's a monster yearly return again of more than 20% following a more than 20% return the year before. But we should also reflect on how weak December was. The Nasdaq barely positive, the S&P down in December by more than 2%, the worst month for the S&P since April. On a Russell, Lisa, we were down by more than 8% on a small caps, and that's the worst month all the way back to 2022.
Which raises the question about whether we really do see tech leadership as the ongoing dominance in this market. The idea that you saw an 8.4% drawdown in the Russell 2000 highlights what a head fake it's been all year, with people talking about the equal weight, about the broadening out, about the small caps, and frankly, it came in tandem with that rise in yields.
Whipsawed. November, the best month of the year for the Russell. December, the worst month of the year for the Russell. Let's turn to the bond market. 2-year, 10-year, 30-year. Front end of the curve, the 2-year ended 23 at 424.99. The 2-year ended 24 at 424.16. The 2-year was almost totally anchored. The front end almost totally unchanged over a 12-month period. The 10-year is where you saw all the action. Lisa, a move of more than 70 basis points, almost 70 basis points higher on the 10-year last year.
Yeah, in the entire year, and 40 basis points of that came in December. And this really raises the question, why? What exactly was driving this huge sell-off in bonds at a time when nothing materially had changed? You basically had the policy prescriptions that have been baked in. You hadn't seen any kind of coming to fruition of any of those. And yeah, you had some outperformance of some metrics, but not necessarily to write home about, which raises the question, who is right? Are bonds underpriced, or are stocks overpriced at a time where essentially people are saying that there needs to be a higher yield premium baked into a bond market that is facing a lot of uncertainty in 2025?
Compare and contrast the performance of bond markets elsewhere with the United States, where yields in China totally cratered. At the front end of the German curve, we dropped by something like 30 basis points, and the long end, the 10-year, rose only half as much as the US 10-year did. Now, once you've established that, push it through foreign exchange. It's part of the reason why we're looking at a euro very close to parity. Euro dollar, Bramo, 103.21.
How much bad news is baked in? And going back to Jeff Yu's point, how much is this baking in some of the negativity in Europe, but not necessarily the opposite, which is the Federal Reserve not being able to cut rates nearly as much as people previously thought? In other words, is that where the surprise is going to come from, that could potentially have even more euro weakness, more dollar strength? Are we reaching the tipping point for how far this can go? These are some of the big questions. At the same time, I haven't heard one person say American exceptionalism is a farce. I haven't heard one person say that actually the U.S. is poised to severely underperform. And what I have not heard is anyone say that Europe is on the precipice of some sort of rip-roaring expansion. And that, I think, is the big question.
Which is why DXY, the dollar index, only had one down week through the whole of Q4. Only one. Just one down week through the whole of the fourth quarter. Under surveillance this morning, an attack in New Orleans, leaving at least 15 people dead and dozens more injured after a pickup truck drove into a crowd early on New Year's Day. The FBI saying they discovered an ISIS flag with the vehicle. And just hours later in Las Vegas, a Tesla Cybertruck exploding outside of President-elect Donald Trump's hotel. And now real questions about whether these two events are linked.
And those questions being raised by President Biden himself, they are investigating that. He was speaking from Camp David. A real question here about what the broader implication is, what type of prevention measures are in place, especially ahead of the inauguration, and then what further threats. I mean, we were just talking about this with James Lucier. What further threats at a time where it's kind of unclear where the leadership has come from, especially in an international sphere, when President-elect Trump has really already taken the mantle and President Biden has really stepped back.
It's a theme already to start 2025, national security issues across several dimensions, and here's another one. The U.S. Treasury Department saying it was hacked by a Chinese state-sponsored actor. The announcement coming just days after the Biden administration said China is behind a vast cyber espionage campaign affecting 9 telecommunications companies.
We've seen this sort of drip drop of news regarding some sort of hack in a host of different tech spheres in the United States from Chinese actors, also from Russian actors. My first thought with this was, how does the U.S. government get the tech expertise at a time where that's at a premium, where all of the companies are paying top dollar for the top tech and cybersecurity analysts? How do you get those people into government to make sure that you're staying ahead of all of the potential hackers? This, to me, is a huge issue, and I want to see something. I mean, I'm curious what Elon Musk has to say about that.
At the margin, do you think that plays into the H-1B argument at the moment?
I mean, sure, I think that that has to do with the government. I think that when you look at the numbers, Amazon, when you look at Microsoft, when you look at what % of their employees come from H-1B visas and people who come in from out of the country, if you look at how many openings there are in this country versus the people who are eligible to fill them, that's got to come from somewhere else. And that's the reason why Elon Musk is saying, look, we got to go with H-1B and we've got to expand and reform this. And that's the reason why Donald Trump seems to be supporting that, despite some of the pushback from some of the MAGA universe.
I think the incoming president's been pretty consistent about it, that he wants to attract the best of the best from around the world. What he does not want is them crossing the border illegally in the South. I think he's been pretty consistent about that over the last year.
The real question has been exactly what those plans look like, what the reforms look like, and how much he can get other Republicans on board when there is sort of an anti-immigration, more broadly sentiment that spans even H-1B visas. So a real question of how he implements, not necessarily any kind of inconsistency.
Dan Ives of Wedbush joining us in just a moment, so look out for that conversation on tech more broadly. Wanted to squeeze this in. European gas prices rising the most since October 2023. The region bracing for freezing winter temperatures without a key source of supply after Russian gas deliveries across Ukraine were halted yesterday. A transit contract between the two nations expiring with no alternative in place.
So, first of all, this isn't a huge surprise, right? There has been preparations for this, people expecting. Back in 2021, Russian natural gas accounted for some 40% of the imports to Europe. Now, through this pipeline, it only accounts for some 5%. But a real question about stockpiling for the future. And frankly, again, this gets the attention turned back to the White House. The U.S. is one of the major sources of natural gas for Europe in the absence of Russia. That has been an area of some debate with President Biden, a real question about whether President-elect Trump will open the floodgates a little bit more with respect to exports of natural gas from the U.S. to Europe.
He has already come out and said he'd like them to buy some more. A lot of people on this programme have come on and said he's pushing on an open door because the Europeans are ready to buy. And that was something Ursula von der Leyen said right out of the gate after his election win in early November.
So let's see how quickly that can get implemented, and let's see what that does to pricing. Does that actually increase prices in the U.S., given the fact that the international divide between Europe and the U.S. in pricing in natural gas has increased, actually, during the whole of this conflict?
We'll get the latest from the Bloomberg team in the next hour, so look out for that. Let's turn back to tech. Dan Ives of Wedbush writing, we expect tech stocks to be up 25% in 2025 as the street further digests a less regulatory spider web under Trump in the White House, with current FTC days in the rearview mirror. Stronger AI initiatives within the on the way, and a Goldilocks foundation for big tech and Tesla looking into 25 and beyond. Dan Ives joins us now for more. Dan, good morning.
Great to be here.
Happy New Year, sir.
Happy
it's good
New
to
Year.
see you. We can talk about some of these big gains through 24. Palantir up 340%, Nvidia up 171, Tesla up 62. Here's another one. Vistra up by 258%. That was the biggest winner on the S&P 500 last year. That's a utility company.
Yep.
What does that tell you about the state of play in AI?
It's about second, third derivatives of AI. I mean, I think the big thing is it's $2 trillion of AI CapEx next 3 years. And I think, look, that's numbers that are really, I believe, going to be in stone. And there's a multiplier. For every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier across software and across the rest of tech and infrastructure. You think about the power, the utilities, nuclear energy, names like ACO and others. I mean, it just speaks to we're going into a new age. It's not just about big tech. I mean, to your point about small caps, I think the big sort of proven moment is the multiplier playing out. It's the rest of tech, the rest of utilities, the rest of the market participating in this AI trend. That's really, if you think about that party, the only ones let in behind the velvet ropes been that Mag 7.
Nvidia has been selling the picks and shovels. They've made a fortune. We've seen all the growth. Does Microsoft and Google and the like that have been spending all that money need to show some gold this year in a big way?
Yeah, and I think that'll start this quarter. I think you're going to see an inflection point in the hyperscalers for Microsoft, for Amazon, for Google, in terms of what we see with more and more of those cloud workloads now showing up. And I think it's all about use cases. That's why you look at the Messi of AI, Palantir, you know, in terms of what they've done, that's just the first piece. Salesforce has been another. Software now starts to actually participate in this AI revolution. That's going to be a key theme across 2025. Remember, with Con done at the FTC, M&A is going to massively accelerate, and that's another theme we're going to be seeing across tech.
What we saw at the end of last year was a lot of these other companies, sort of the side effects of AI or the actual applications. We saw them take a pause in the applications of AI and really study exactly the use cases, study the most efficient way to do it. They stopped deploying as much cash. What makes you think that they can apply some of the AI technology quickly enough to keep delivering the kinds of expansion and gains in the hyperscalers to keep a 20-25% return that you're expecting in 2025?
Yeah, it's a great point. Look, that's all the work we do. I mean, we look at, when we talk to enterprise around the world and all the travel we do in Asia, it's showing that these use cases, they're exploding for the enterprise. So as the ROI starts to continue to increase, that's why you're starting to see, you saw Palantir starting in Salesforce, you're going to see Mongo, Snowflake, and others. You're going to see it spread across the board on enterprise. But again, like the ships left the port. In other words, the AI CapEx is going to be there. Now 2025 is going to be about showing it, proving it in numbers. And that's why the reason we think stocks or tech stocks are going to be up 25%, it's not just about big tech. It's about the rest of tech participating, software, infrastructure. And look, I always say, like, haters hate. The last few years, that's sort of been, what we've seen in tech. They will continue to sort of fire in a crowd theater type situations, but I think tech continues to move higher.
How predicated is this theory on the idea that there can be some sort of expansion of the H-1B visas, that there can be an ongoing increase in employees and top talent to the United States?
For the first time in 30 years, the U.S. is ahead of China. I mean, in my perspective, from when it comes to tech. But to fuel that in terms of AI revolution, it's talent. And I think what we've seen, we've definitely seen a lack, I'll say supply, demand. These companies more and more need to continue to fuel this with talent. So when you look what we're seeing with H-1B and ultimately as that all plays out, it will be something very, very important that plays out in Silicon Valley and across the tech world in 2025.
Elon Musk has been at the forefront of this debate, this argument over the holiday period. Let's talk about Tesla. Tesla, an outlier in a pretty dreadful auto market, particularly for the European players. I think it was Stan Druckenmiller that once said, you'd be surprised by how few people understand what makes a stock go up or down.
Sure.
What makes Tesla go up or down? Because it sure as hell doesn't seem to be car sales. It seems to be something much bigger than...
And we're going to have deliveries probably in the next few hours, right, in terms of Q4. Look, I think this is an autonomous AI story for the next few years. And it goes back to the bet for the ages that Musk made on Trump continue, I think is going to really play out as the autonomous future. That's what you're betting on in Tesla. You don't see that in numbers today. But I think ultimately, I think that's worth $1 trillion alone in terms of the AI autonomous story. But next few hours, this week, we'll be talking about deliveries. And it comes down to China deliveries, which were really a disaster at points in the last, call it 12 to 18 months, have now started to rebound for Tesla, and that's going to be very important.
What gives you the confidence that that will continue? Because there are some similar questions happening in the luxury space with companies like LVMH. Is China actually bottoming out for the consumer side of things? What gives you that confidence for 25?
It's what we see in terms of demand, in terms of what we see in terms of the overall China market for EVs. I think Tesla, I think a lot of those price cuts in the rearview mirror, we're going to have white knuckle moments. But ultimately, I think China is something that could be up 20% when it comes to delivery for Tesla. And that's why I think right now it's one where I think where the bears have sort of misunderstood Tesla, it's 10 to 15% of delivery story now. It's 85, 90% AI autonomous in terms of the future for Musk and Tesla.
Sort of when you put together some of the things that you're talking about, you think for the first time in 30 years, the U.S. is actually ahead of China when it comes to development. At the same time, Tesla's dominance and success has hinged on its success in China. So how do you see the evolution in 2025 of the increasing divide, the increasing isolation between China's sort of tech stack and the United States' tech stack, and how those sort of both compete but also evolve in parallel?
Yeah, and it's a game of high-stakes poker, because the reality is that the reason Jensen's godfather of AI and what we've seen with NVIDIA, where the chips coming from China, coming from Asia. So that's why we're going to see this all play out with the China tariff discussions. I believe Musk is going to be heavily involved there. Cook, 10% politician, 9% CEO. Apple also plays a key role here. But I just believe that's something that ultimately, it's not going to spoil the AI revolution trade. It's not going to spoil the chip trade. We will go through white knuckle moments, but my view, and it's been the playbook the last few years, you buy the winners on those opportunities. And I think that's going to be the theme this year.
Pick the winner of the year. Your number one stock pick for 25. What is it?
I think, to me, number one stock pick, I think continues to be NVIDIA here. And the reason is that there's only one game in town when it comes to AI. It's the godfather of AI, Jensen NVIDIA. Stocks obviously sold off. I think we sit here, them along with Apple will be the first ones in that exclusive $4 trillion market cap club.
Wow, the stock is up again this morning by 1.6%. Dan, Happy New Year.
Happy New Year.
Good to see you, buddy. Thanks for being here. Dan Ives there of Wedbush with an update on stories elsewhere this morning. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Chinese stocks posted their worst start to a year in nearly a decade. The CSI 300 closing lower by nearly 3%. Manufacturing data posted earlier this morning showed a slower pace of expansion in December. In December, China signaled more public borrowing and spending in 2025 with a shift of policy focus to consumption in an effort to repair the economy's weak links. Sun Art shares tumbled by a record in Hong Kong after Alibaba agreed to sell its holdings in the hypermarkets operator to a PE firm. The Chinese e-commerce giant could receive up to $1.6 billion from the sale to DCP Capital. That's much less than the $3.6 billion it paid in 2020. That deal accelerates Alibaba's retreat from physical retail spaces, focusing instead on the cloud and online marketplaces. UK house prices climbed to within touching distance of a record high to end 2024. A resilient property market that gathered just more momentum. It was the fourth consecutive monthly increase. Data elsewhere showed solid buyer demand. Despite affordability challenges, UK house prices are expected to climb 4% in 2025. And that's your brief, John.
Hey, Danny, thank you. Danny, we'll be back in about 30 minutes' time. Up next on the program, dollar strength persisting.
We had a much stronger dollar for the first 6 months of the year against a trade-weighted basket of currencies. You're going to continue to see growth differentials and interest rate differentials drive the value of the greenback.
Kit Jukes of SocGen, just around the corner.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Stocks are up, bond yields are lower. We're higher by 0.8% on the S&P. On a 10-year yield this morning, we're down by 3 or 4 basis points. But check out the euro, weaker again, 103.28. The low of the session, 103.14. The lows we have not seen since November 2022. Some euro weakness, that's for sure. Under surveillance this morning, the dollar strength persisting.
We had a much stronger dollar for the first 6 months of the year against a trade-weighted basket of currencies. You're going to continue to see growth differentials and interest rate differentials drive the value of the greenback. The question is not will the dollar get strong, but will we get in a situation where the fundamental underlying strength of the U.S. economy, with that new policy piled on top of it, turns us into a situation where the dollar soars and we get calls for dollar devaluation.
So here's the latest this morning. Traders watching if the greenback can sustain its momentum this year after its strongest yearly advance in nearly a decade. Kit Jukes of SocGen writes, given the recent economic and political trends, dollar bears should hibernate over the winter. Spring shoots of life in the European economy, signs of fatigue in this incredible US cycle, and clarity on the policies of President Trump may all help by summertime. Patience is required through the winter and spring. Kit joins us now to kick off 25 in the FX market. Kit, Happy New Year and welcome to the program, sir. Let's start with US exceptionalism. What is it built on and how sustainable are those pillars?
Some of it's sustainable. I mean, the technological gains, you've just been talking about them, they're a huge part of it. If we believe in the AI revolution and we believe in Mag 7 and everything that's happening, then you know, the US has cornered that. So let's not knock that. I wouldn't necessarily knock the fact that the U.S. has run a significantly more accommodative fiscal policy since 2020, really. You know, everybody in Europe's been struggling to try to get their budget balances back under control. The U.S. has kept them accommodative policy and has had more growth, and that helps keep the deficit a little bit more under control than elsewhere. So there's more than one piece to this that's been there. But if the U.S. does have to tighten fiscal policy, at some point, that may slow things down. We'll see how big the AI revolution really is in the next 10 years or so. I am not clever enough to judge quite how much continued growth that can give. And we'll see whether the U.S. can cope with the demands on the labor force, because the economy is running at this point on wealth gains from asset price increases, a tight labor market, a fairly divided economy in terms of winners and losers. And it doesn't look to me as if it's got much potential to accelerate in growth or indeed to continue at recent growth rates for that long unless we can get a productivity miracle from somewhere.
Kit, what do you think is going to drive further dollar strength if we get it, or perhaps euro strength? Will it be European disappointments, European surprises to the upside? Will it be rate differentials, or will it be ultimately just a real question of what the neutral rate is in the United States?
I think the neutral rate is look higher in the United States than in Europe, and you know that's a challenge that doesn't get written up about enough. Just that if my neutral rate's higher than your neutral rate, my currency ought to be going up forever. I mean, it's not a stable equilibrium if we have these big divergences in neutral policy rates. So that's a major factor, but I think it's largely in the price. What I'm most uncertain about is the politics, in the sense of, have we priced in too much of what people expect from President-elect Trump, or have we not priced it all in at all yet in terms of what that does for the dollar? I've read so many pieces talking about the possible negative growth effects of his tariff proposals, plans, threats, whatever we want to call them. If he wants to get a deal that's good for the US, it has to be a deal that's good for the world and good for global trade. And if he does that, there's more upside to growth elsewhere than there is in the US from those deals, if only everybody could embrace them. And that wouldn't be good for the dollar. So at the margin, I think the politics will be more important than the kind of straight economics. If all we're doing is trading what's happening economically now, I think we're just going to have a very strong dollar for as far as the eye can see. The debate about whether it can get back to parity for euro-dollar or a little bit stronger generally than it is now, it's a tough debate. It's a really expensive currency that will stay expensive as long as the rest of the world is shoveling all of its savings into the United States to see how much money it can make out of the U.S. equity market.
Just quickly, is the spike that we've seen in natural gas prices in Europe just noise, or is that something you're watching that could potentially affect the pair?
Oh, I think we have to watch it pretty closely. I mean, we've known this was coming for long enough that you'd have thought some of it would be in the price, but with raw materials, nothing ever is, right? If the pipes close down and it suddenly gets really cold, then you can have a short-term spike that can have a short-term impact on growth, that can have a short-term impact on the currency that's pretty negative. That the way we got euro-dollar to 95 back in 2022 was a terms of trade shock caused by higher gas prices. So we shouldn't ignore it completely.
Hey, Kit, good to see you. As always, Kit Jukes there, SocGen on foreign exchange. Euro-dollar 103.25, the lowest level for that currency pair going back to 2022.
Yeah, and this really speaks to the fact that the strongest performance that we've seen in Europe are some of the tourist locations where a lot of international tourists are going. And I know some people are saying, oh, there you go again. But truly, how many people went to Europe over the winter break because it is just so much cheaper given where the currency is?
Have you booked yet?
Maybe. I don't know. Have you?
I have.
Okay.
I'll admit. Are you going to admit that you have now?
Maybe. I don't know. I'll decide. We have a couple hours.
I imagine we're not alone at 103.26 on euro-dollar. Up next in the second hour of Bloomberg Surveillance, we'll catch up with Sarah Hunt of Alpine Saxon Woods. We'll speak to Bloomberg's Tyler Kendall and Will Kennedy, and we'll catch up with Earl Davis of BMO on the bond market from New York City. Welcome back. This is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It'll be easy, but at least there's a theory of change.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
I think markets are still really euphoric.
The sentiment dial has been turned up significantly to end 2024. We think that's becoming a bit of a liability as we walk into next year.
The next couple weeks we think are going to get a little choppy.
I think we're actually going to get off to a bit of a sloppy January.
As goes January, so goes the year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's set some boundaries. January 10th.
Yeah.
That's like the deadline for Happy New Year's.
Because it's payrolls day? Is that why?
I think once you get some real economic data, it's no more Happy New Year.
Yeah, I'm going to debate
That's my view.
I actually think that if you haven't seen someone through the whole of January, you can say Happy New Year.
If you haven't seen them for that long, they're not that important to you, and it's disingenuous.
Okay, well that's...
How about that for a comeback?
I personally, I'm inclusive. I'm trying to bring people into my, orbit. I think it's wonderful. Happy New Year.
Happy New Year to you too. On this January 2nd. Equity futures on the S&P 500 positive by 0.9%, on the Nasdaq 100 up by 1.1. Speaking of January 10th, payrolls just around the corner, not tomorrow, but the following Friday. Then on the 15th, you've got CPI. On the 20th, inauguration. And then at the end of the month, you'll hear from the Federal Reserve.
Yeah, and to me, here's a question. We've seen a real shift upward in yields, and there's a question about why. Is it justified? Is it because the economic data has been better than expected? Or is it because there is this promise of some sort of fiscal package that will increase the deficit and that will thus increase the yield premium? This is the key, frankly, to where January goes and thus where some of the tone will go, because that has been behind some of the hiccup that we saw in December.
We've got to talk about where we have been and the month of December. I mentioned that we'd had this 70 basis point move on a 10-year yield through 2024, and Lisa was fast to point out that 40 basis points of that came in the month of December. The world is becoming really stretched. Jay Pawlowski would come on the program and talk about the tripolar world. Let's talk about those three poles. The United States seems to be heading in its own direction. China's heading in the opposite direction, and Europe seems to be stuck somewhere in between. And I'm not sure how much more stretched this story can become in 25.
Yeah, another way of saying that is, how much has this been fully priced? This idea of American exceptionalism and everyone else falling off a cliff, is that where the surprise really could potentially be? And that's what we heard from Jeff Yu of BNY Mellon, that basically there is more upside surprise in some of the laggards. That said, where is that exceptionalism going to come from? I will just point this out. We were talking at the end of last year about how the economic surprises in the U.S. kept inflecting to upward. Actually, the Citi U.S. Economic Surprise Index went negative for the first time since October by the end of the year. So it raises the question of, is the data starting to lag behind, and question maybe how much momentum there is behind that story?
Relative to expectations, and I can give you a sneak peek of the payroll survey here at Bloomberg. A number of economists have already posted their estimates for next Friday. 153 is the median at the moment. 153K, that would be down from 227. That's the latest look. I'll give you another look tomorrow morning. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Words as stocks close out their best two-year run since 1998. We'll speak to Bloomberg's Tyler Kendall as law enforcement probes a possible link between the New Orleans attack and the Vegas Cybertruck explosion. And we'll catch up with Earl Davis of BMO on the fixed income outlook for the year ahead. We begin this hour with stocks looking to snap a four-day losing streak, a week end to an otherwise solid year of gains. Sarah Hunt of Alpine Saxon Words staying cautiously optimistic into the new year, writing, what will January bring? Perhaps a bit of a relief rally after the year-end letdown. After 2 years of 20% plus returns on the S&P and even better returns for the NASDAQ, it is difficult to build in a third strong year. Sarah joins us now for more. Sarah, good morning and Happy New Year to you.
Happy New Year.
It's good to see you.
Good to see you.
Let's start with your point. I think it's really important. We've had 20% plus returns, 23, 24. How rare would it be to see something similar in 25?
It would be quite rare. It doesn't mean it can't happen. I mean, certainly for this year, people were not expecting double-digit gains at the beginning of the year. And I think that it's really just a question of tempering expectations and saying, you know what, we've had this great run. I don't think a disaster is looming, but at the same time, to expect that kind of performance year in and year out seems very surprising, especially given where valuations are. You'd have to see a really big a really good economic backdrop. And to your point about the tripolar world, the U.S. is in one place and the rest of the world is in other places.
Talk to us about where these surprises came from. We've reflected on this before, but the numbers are important for the year before as well. The year before, looking out 12 months, the average forecast was 4,800, and the S&P closed the year at 5,881. So the S&P 500 finished 1,000 points higher than we expected it to. Where did that surprise come from?
I think it came from a couple of different places. I mean, if you'd looked at earnings estimates at the beginning of last year, just sort of the way we look at it at the beginning of this year, I think people thought, including ourselves at one point, that that was a little bit optimistic. But you really had stuff come through on the earnings front. So the AI story, which was just a backbone building exercise in the beginning, started to broaden out and other people started to talk about it and companies really started making money. And that made a big difference into both earnings and sentiment. And you layer on the sort of quantum computing and where that goes, we don't know, but it's another leg in that technology story. And I think that that optimism is really helpful. But we were also starting from a different place. So from valuations where we're starting here versus last year, even if you do get the growth that people are starting to build in, you're kind of growing into your earnings as opposed to being able to expand your multiples some more. So I think that's a little bit where the hesitation in growth comes from.
2024 was kind of a confusing year because you had a lot of stories kind of layered on top of one another. You had underperformance of the Russell 2000 while you had that outperformance of those tech accelerators in this sort of revolution that we just heard about from Dan Ives. Can that continue powering the gains? Do you have to kind of keep hiding out in that tech story and not necessarily bet on the rest of the universe that just had a terrible month, actually?
So I think the thing is it's more about an and than an or, because I think that the tech stocks and the tech sector is going to continue to perform fairly well, and you've seen a lot of excitement there, but there needs to be a little bit more of the and that Russell underperformance that we've been talking about is now getting to historic levels, both from size standpoint and from a timing standpoint. But the economy has to be in pretty decent shape, and I think that people are okay thinking that the U.S. is in pretty decent shape, but some of those companies also need the global economy to be good as well. And the interest rate picture does reflect on the small caps and the mid caps. And I think that's part of what was a problem in December, which is where a lot of that underperformance after starting to catch up in November came back through.
As John was mentioning, we saw an 8.4% drawdown in the Russell 2000 in December. That was the biggest monthly decline since September of 2022, and it came with a 40 basis point increase in benchmark 10-year yields. Are rates cheap or are stocks expensive?
Yes. I think, again, it's a combination of things. Stocks are expensive. Are rates cheap? I'm not really sure how that's going to play out. There are so many factors at play on the rate market because it's partially the Fed. It's partially concerns about the deficit. It's partially about where spending is going to go. And globally, we have a lot of indebtedness that continues to climb. And so far, that's been okay, and it's been okay. And at some point, it's not going to be okay, and I don't know when that point is. You could argue it should have been before. You could argue it'll take another 2 or 3 years. I don't know, but it clearly ends up having an occasional spooking effect. And then when that happens, equities start to wobble because they get worried that if rates get higher, they're going to have trouble given the fact that you've got multiples where they are.
Some of this speaks to how difficult the balancing act will be in Washington, D.C. for the incoming administration. They want a high-growth economy. They want a low-inflation economy. At the same time, they want a sustainable fiscal trajectory. How difficult is it going to be to balance those three things?
Now, when you throw tariffs into that mix, and that even adds another level of complexity, I think it's very difficult to balance that. And I think that's where the market shifts from enthusiasm for what might be good to concern about what might be bad and back and forth. And I think that's what you saw in December after you had that fight over the CR. Right? You had all of a sudden people going, well, if there isn't consensus, then maybe we don't get all those things that we're building in as quickly as we want, and some of these things that we're worried about can come to the fore. And I think that's where you have some real tension as to how this is going to play out. In the beginning of the year, I think could be quite volatile.
Do you feel more comfortable betting on them being right about at least one of those three things over the next 4 years, and which one would it be?
I think that the U.S. growth situation is in pretty good shape, and I think that if you don't step on it, and or if you take some of the things that are slowing it down, some of that regulatory push off, some of the things where you have, I think that could be really helpful. But the rest of the world also has to do fairly well, and you have a lot of different tensions between spending. We've been in a good economy and spending money like, the proverbial sailor. So I think that there are some questions about whether or not that's sustainable and how you rein that in and to what degree that starts to impact growth as well.
At a certain point, what's your biggest concern for this year? Is it an acceleration or sort of an upside surprise in inflation? Or is it a downside surprise in some of that growth trajectory that you're talking about in the United States that's powered the global economy?
I think some of the concerns would be where the data is going to go, because we had a lot of revisions on the employment data, and that was one of the things that people were pointing to say the U.S. economy is very strong. We had some revisions that said maybe it wasn't quite as strong as we thought it was. So I think that inflation seemed to have been a big worry for the Fed when they cut in December, but it also seemed that we got some data afterwards that maybe took some of that sting out of it. So I'm less worried that that's a huge problem than I am that it's just a constant problem that makes other things a little bit more difficult. I think really the U.S. economy is probably the biggest driver. So it needs to do well for those earnings to come through, for companies to do well. That needs to continue. And if it starts to look like it's not, that might be a problem. The LEI index had been negative for a while and actually flipped to positive for the first time, I think in November or December. So there's some good news in there, but I think that's mixed economic data. I think that's a concern.
We have 18 days until the inauguration of President-elect Donald Trump. A real question right now about a vacuum of leadership and the potential attacks that we've seen. I'm just wondering how, from a market's perspective, you view some of these developments, at what point they weigh on some of your outlook or some of your investing decisions, or is that just completely independent?
Unfortunately, a lot of things that are negative that happen like that don't end up being as enormously predictive for markets as you would think that they might be. So something like what happened in New Orleans and something, if it starts to become like, oh, there's a really big thing going on here and they're all linked together, I think that does start to weigh on people's consciousness and psychology and everything else. But I think it's a lot about are we going to see more things like that, or where are things going to go? And if we continue on a reasonably good economic trajectory, people don't tend to focus on that as much, except from a news standpoint as opposed to from a market standpoint.
Have you got a favorite sector for the year ahead?
It's interesting because I was thinking a lot about that, and I think it's more about a theme than it is about a sector and who participates in those themes. So all the things that we've been talking about for the last year, not just AI, but all the contingent things that go around it. We need a lot of power generation. We need a lot of infrastructure. There are a lot of things that are going to happen that we need things for, and that plays into the industrials, it plays into parts of the real estate market, the data centers, it plays into all the utilities, it plays into a bunch of different places. So I think it's more about those themes than it is about specific sectors.
Some of those utilities had a stunning year last year, that's for sure. Sarah, it's good to see you. Happy New Year. Sarah Hunt of Van Fine Saxon Woods. We could keep doing it for another week or so until January 10th when we get payrolls.
And then it's over.
We do get a sprinkle of economic data before then. It's worth pointing out that a little bit later this morning, Lisa, jobless claims come at 8:30 Eastern Time. Later on today, of course, 9:45, the S&P Global US Manufacturing PMI. Tomorrow, ISM Manufacturing to close out the week.
Yeah, and actually, jobless claims used to be important, and suddenly they flatlined. And at a certain point, I wonder when that's going to become an important indicator. PMIs are going to be an important indicator, too. And this is something people are pointing to, especially as they roll over in China. Can the U.S. continue to see expansion in services with a catch-up in manufacturing, or does that continue to stall going forward?
Your point on claims is an important one, though. The estimate today is 221. The previous week was 219. We had this Q3 employment head fake that shook this whole market. Remember, the Federal Reserve was going to cut interest rates aggressively, more than the 100 basis points that they delivered, because it was time. You needed to insulate the labor market, and that was going to unlock a ton of what? Dollar weakness. That was the story only 3-4 months ago.
Yeah, this whole question from Jay Powell about how we will not welcome any further weakening in the labor market. This is why there was such a shift in tone from the Federal Reserve, and could be one of the reasons why we saw such a backup in rates. If we see a big increase in initial jobless claims, does that unwind some of what we saw in December?
Claims data later on this morning, 8:30 Eastern Time. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A deadly attack in New Orleans' French Quarter very early on New Year's Day killed at least 15 people and injured dozens. The suspect, an American Army veteran, was killed at the scene. The FBI is investigating the attack, which involved a pickup truck and improvised explosive devices. The FBI is also looking into possible connections to terrorist groups and whether the suspect acted alone. The attack happened hours before the Sugar Bowl was set to kick off at Caesars Superdome in New Orleans. The game was postponed until this afternoon. Elon Musk says the explosion of a Tesla Cybertruck outside the Trump Las Vegas hotel was probably an act of terrorism. The driver was killed and 7 people suffered minor injuries. In a series of posts on X, the Tesla CEO says the explosion was caused by fireworks or a bomb carried in the rented Cybertruck and was not related to the vehicle itself. President Biden says officials are investigating whether there's any possible connection to the attack in New Orleans. Elsewhere, Bloomberg reporting that Nippon Steel has offered a 10-year guarantee that it wouldn't cut production capacity at U.S. steel mills in Pennsylvania and several other states without approval from the Treasury-led review panel. The proposal aims to address concerns raised by the U.S. Committee on Foreign Investment, which said the takeover would lead to a decline in American steel output. The report gave U.S. steel shares a boost on New Year's Eve, but President Joe Biden is still expected to block the deal. That's your brief. John.
Danny, thank you. The deal offer that just will not go away, will it?
Well, the idea that they're doubling down now ahead of President-elect Donald Trump getting in and the market thinking that maybe this is going to take some, have some legs.
More on that story a little bit later. Up next on the program, an important conversation. U.S. security in the spotlight.
We're tracking the explosion of a Cybertruck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans.
That story up next.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The average forecast, or guesstimate as we might call it, on the S&P 500 for year-end this year is about 6,600 on the S&P after closing last year at 58.81. Just a series of big calls, including Oppenheimer's John Stolfus, looking for 7,100 on the S&P 500. Equity futures this morning up by something like 1%. Your day ahead, we've got some jobless claims a little bit later this morning. S&P Global Manufacturing PMI at 945. Then on to tomorrow, ISM Manufacturing. Then next week, it really starts, Bramo. January 10th payrolls. The week after that, CPI. Week after that, inauguration. Week after that, a Federal Reserve decision.
And this comes on the heels of seeing a pop-up in yields and a pop-up in expectations for the U.S. exceptionalism at a time where we just came off the biggest two-year gain in the S&P 500 since 1998. When you take a look at some of the expectations, this is going to essentially be whether people have too much good news baked in or not enough at a time where the U.S. economy continues to outperform.
You mentioned the bond market, big moves through last month, 40 basis points higher on a 10-year, over the last year up 70, the 10-year this morning, down about 4.53. Under surveillance this morning, U.S. security in the spotlight.
We're tracking the explosion of a cyber truck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans. Thus far, there's nothing to report on that score at this time. While this person committed a terrible assault on the city, the spirit of our New Orleans will never, never, never be defeated.
So here's the latest this morning. Officials investigating a pedestrian attack in New Orleans that killed at least 15 people. This is police in Las Vegas investigate a Tesla Cybertruck explosion outside of the Trump Hotel. President Biden saying federal law enforcement is looking into a potential link between the incidents. Bloomberg's Tyler Kendall joins us now from the White House. Tyler, welcome to the program. Let's just start with the possible link. What evidence do authorities have that indicates these two events might well be linked?
Yeah, good morning, John. So as you mentioned, and we heard President Biden saying that the FBI is looking into whether or not there are any potential links. We are still waiting for additional information on that front. I can tell you that law enforcement officials in Las Vegas have confirmed that they are working with Elon Musk on their investigation there into how this explosion happened. Now, in terms of what we do know about that explosion, the officials in Las Vegas have noted that Elon Musk has provided them with extensive video footage from Tesla charging stations across the country so that they could track this vehicle's whereabouts up until the point of the explosion. Now, in a series of posts on X, Elon Musk says that his team at Tesla has confirmed that it wasn't necessarily an explosion of the Cybertruck itself, but rather that a fireworks or a bomb were likely planted into the bed of the truck that ultimately caused the destruction. Now, he went on to say that ultimately it was how the Cybertruck has been built that has helped to contain the blast. Law enforcement officials in Las Vegas, too, also noting that that likely helped to contain the blast and minimize the casualties and injuries that we saw from that event.
Tyler, do we have any intel in terms of whether the threat is persisting or whether there is any additional incidents that people are investigating that could potentially be connected?
Well, I can tell you that here in Washington, we're already starting to see reaction and also security start to ramp up, right? The D.C. police in a statement late last night saying that they are going to ramp up security here in the nation's capital ahead of what is expected to be a busy month between January 6th and, of course, the inauguration on January 20th. We're also starting to see congressional reaction saying that they have to start to take action to confirm President-elect's nominees, particularly when it comes to national security picks in order to prevent any future attacks like this happening so that they can all get on the same page when it comes to the nation's security.
And Tyler, this comes at the same time where there's reports of a potential hack into the U.S. Treasury Department. We've been talking all morning about the multifaceted threats to the U.S. government. How much bipartisan support is there to really come up with a comprehensive plan to hire the personnel and to make sure that there is the oversight to prevent these types of attacks?
Right, I would say it's actually incredibly high. Securing the nation's intelligence infrastructure and also cybersecurity has been a bipartisan push during actually the Biden administration, and we're expecting to see it also continue into the incoming Trump administration. Of course, when we're talking about potential foreign actors in these issues, China, for example, has long been a bipartisan cause for both Republicans and Democrats on Capitol Hill, and we're already starting to see lawmakers step up and say that they're ultimately going to need to take action here.
Tyler, we had a guest on in the last hour who questioned the president's cognitive ability and whether foreign adversaries are testing the United States of America if we're at a vulnerable time awaiting the handover of power, the transition on January 20th. What do those conversations sound like in the nation's capital?
Well, I would tell you that right now, one of the biggest issues that the nation's capital is facing is the upcoming speaker election tomorrow. And there's already starting to be grumblings about how that could potentially impact January 6th, which is the certification and the count of the Electoral College votes, likely to go off, as Republican leaders are hoping, without a hitch. But ultimately, President-elect Trump is starting to get involved in those negotiations because he is trying to qualm all of those fears that there could be any issues with getting that certification done. He's trying to make sure that he can push his agenda on congressional lawmakers, but we're going to have to wait and see how effective that ultimately becomes. For example, we just saw last month when he tried to weigh in on keeping government spending open, that ultimately backfired on him as he tried to push lawmakers to lift the debt ceiling. And we're starting to see more congressional Republicans come out and potentially voice opposition against House Speaker Mike Johnson, despite him having President-elect Trump's backing.
Tyler, appreciate your time. A range of issues there. Tyler Kendall there of Bloomberg in the nation's capital in Washington, D.C., as this country faces some national security issues across several dimensions. Speaking of the incoming administration, Anne-Marie, who's not here today, has said this a million times, that in the early part of this administration, everyone's a Joe Manchin in Congress. And we're seeing some evidence of that already over the past few weeks.
Basically, that the squeaky wheels are going to get all the attention, and that